Thank you. Welcome back, everyone, from lunch. I hope you got a chance to stretch your legs and at least get some nourishment, as it is a short lunch break that we're taking. I'm Cindy Jeffries. I will be your facilitator this afternoon. Just a couple quick announcements. We will have public comment this afternoon from 4 to 4:30. And if you are someone who has received a time slot, please make sure that when you log into the session that you log in under the name that you registered with would be helpful. And comments should be surrounding the topics before the committee today so that it's most helpful for them. That would be wonderful. Of any of the topics for this negotiated rulemaking. For the committee, just a quick reminder that if you are swapping off with alternate and primaries, please send us a quick note of that so that we can announce it so the public is aware of that swap out. With that, the agenda this afternoon is to, as quickly as possible, finish up this preliminary discussion on financial responsibilities so that we can then move into the change of ownership and control, and completing preliminary discussions on that, and ending today with the start of certification procedures. So I know it's a robust agenda, but it is our hope and intent to at least get through all preliminary discussions on all of the topics and issues by the end of this week, so that everyone can prepare for the second session in February. So with that, I'd like to open up the discussion, pick back up where you left off. And I believe, Kelly, you were up.
Great, thank you. Two things. One, in the F1, Roman numeral 1, just my same concern as it relates to the liabilities, as opposed to, if it's liabilities only resulting from a change in composite score, or if it's all liabilities. So I just want to put that on the table. My second one has to do, and there's no changes to this section, but it's in reporting number 3. I think we potentially have an opportunity here, and I'm hopeful that the department will take this into consideration. So this section, in essence, talks about what I would consider an appeal process, right? It talks about a preliminary determination and then giving institutions the opportunity to provide certain things to demonstrate that they are still financially responsible as it relates specifically to the triggers. So I would ask the department if they would consider, and we can craft some language, if they would consider putting the composite score within this section as well, as far as having a preliminary determination based on that composite score with the option or the ability to provide additional conditions or circumstances, or even to review the calculation of the score with the department before that mandatory letter of credit or declaring an institution not financially responsible is issued. We talked about an appeal process in the last negotiation that we did this. It didn't make it into here. I do think that there's an opportunity to insert it into this part. Specifically, one of my concerns is as it relates to definitions of long-term debt, which I talked about yesterday. We have not seen any of the scores or the results of institutions submitting their scores for the first time because of the delays or the pushback in when those were required based on the pandemic and such. So I'm concerned that there might be institutions that, based on those long-term debt rules, may potentially fall into the zone or fail because debt has now been excluded, even though it was just simply a refinancing. So I offer that up for consideration.
Thank you.
Thank you, Kelly. Barma, you're next.
The question I was going to pose, it's kind of challenging because there's a real sense in which it may belong in administrative capability, but we're talking about it here. The consequence of failure to make these very critical reportings is that the department may take some action against the institution. And the problem here is that at the end of the day, people run institutions. You need to expose individuals to consequences if you want to change corporate behavior. And I'm just wondering whether the department can contemplate something a little more consequential than simply suggesting that failure to make the reporting could have consequences for the institution only. There is language in administrative capability in the statute that, first of all, clearly delineates between nonprofits and for-profits, and the focus tends to be on the for-profits and ownership interest or individuals exerting substantial control on for-profit entities. And it strikes me as wise for that authority to be exercised under the broad authority the statute gives the Secretary for financial responsibility purposes, to ensure that individuals themselves individuals in substantial control of for-profit entities face consequences when they fail to make the necessary reports.
Well, I'll take that back as a suggestion. If you have specific language you want to share, feel free to do that.
Thank you. Okay, I don't see any other hands, Greg, on the section E through F1 Romanet 9. How would you like to proceed? Do you want a temperature check on those? Do you want to go a little further?
Yeah, let's do a temperature check because I would like to keep it by paragraph if I can before we move on.
Sure. All right, so we will do a temperature check on section E, subsection E through F1 Romanet 9. So if I could please see your thumbs nice and high. Okay, there is one thumbs down. Anything you want to add, Brad, as a concern? I can't hear you.
Sorry, I had my mic muted. I added my one concern right before lunch, and so that was it.
All right, great, thank you. So Greg, and Aaron Washington is sharing with us, I believe, still this afternoon. So if you want to queue up the document, Greg, you want to take us through the next section?
Yeah, so the next, G is included, though there are no changes to paragraph G. So we're going to move on to paragraph H. Before I do that, I wanted to just briefly, I promised Amanda a response to her question regarding the discretionary trigger related to annual dropout rates from the institution. And our question was, does the department have any, I think, particular formula by which we calculate that? And is there any threshold that we use? The answer to both of those questions is no. No. And partially for those reasons, we've not invoked that. We've not yet invoked that particular discretionary trigger. So we do welcome any suggestions from the committee as to what might be an appropriate methodology for that. There are number of them. We have a methodology and admin capability for initial institutions. There's an IPEDS methodology. We've not applied either of those or any other, but if there are suggestions, I'm willing to entertain those in writing. Since we've moved on from that section, but I didn't want to answer that question. Okay, we're ready to move on to paragraph H, which is audit opinions and disclosures. And we have suggested language here that clarifies the requirements around an institution's ability to continue operations. So made a few clarifying changes here. Even if the institution satisfies all the general standards of financial responsibility, in paragraph B, the secretary does not consider the institution to be financially responsible if the institution's audited financial statements, the opinion expressed by the auditor was adverse, qualified, or disclaimed opinion, or, this is in the addition, the institution was required to include disclosure in the notes to the financial statements that contains information about the institution's ability to continue operations unless the secretary determines that a qualified or disclaimed opinion does not have a significant bearing on the institution's financial condition, or that the institution's ability to continue operations has been alleviated. So just a couple of wordsmithing changes there, but they are present, so I wanted to go over them. And that is all for 171. So I don't think we need to take I don't think we need to do a check there. So but I will ask if there are any comments or questions before we move on to 174 and 175.
Barmack.
I apologize, but you kind of jumped over G so quickly that I didn't get a chance to interject.
Oh.
I just have a question here. With the advent of new arrangements under which solidly public institutions enter into arrangements that purport to be ownership arrangements with for-profits, does this necessarily satisfy the secretary that, and I don't want to name names, but like the earliest example of it, where the entity being acquired purported to be a public institution solely on the basis of the fact that the parent company, that the parent entity, a public state university, was behind it. Do we not need some language here to ensure that public transcends just a letter from somebody saying, you know, we back the liabilities? I mean, I'd be happy to name the school if you want to, but
when we get, yeah, I appreciate you not naming the actual school. I think we should try to avoid names wherever possible. We do propose some changes to what is considered to be not-for-profit in the under change of ownership, or when we get to that particular paper. So I would ask that we hold comments related to that till we review those sections when we get to that particular paper. Steve, do you have anything you want to add to that?
Steve, you're on mute.
I think we should welcome comments as to whether we need to make changes in the language in the regulations here as well.
Yeah, certainly open to that.
yeah, my concern again, the conversation becomes difficult when you can't name names, but it's critical that the arrangement, specifically Romanet 1 Cap B, should transcend the parties to the transaction. It shouldn't be so easy as for the two parties to a transaction to satisfy, to basically cloak behind the suggestion of state backing unless the state itself provides that assurance. Do you see my point that we have had cases where the state is not actually on record saying this acquisition is backed by my full faith and credit, but an entity that the state has backed has provided a letter, and I feel like the department needs stronger assurances that any acquired entity is indeed fully backed by the full faith and credit of the state that backs the parent entity.
So Barmack, you don't believe that the current, so it says provides a letter from an official of that state or government entity. Unless that were somehow
It's the or other government entity. If the I would exclude the parent entity from being that other governmental entity. In other
Okay,
words,
so-
public university A acquires for-profit entity B without the state fully endorsing it, and all you have in your hands to treat the new entity B as a public institution is a letter from the CEO who negotiated that deal on behalf of public university A. I feel like you need to have the state back that.
So you want a clarification that government or other government entity does not include officials of any school
Yes.
involved in the acquisition or something to that effect?
Yes.
Okay, I see what you're saying. We'll note that.
Thank you.
Great, thank you.
Okay.
Sorry, Jessica?
Thanks. I I just had a quick question on H. Sorry, and you don't need to respond right now, but is there a meaningful difference between H being H versus being a mandatory trigger? And if there isn't, maybe it should just be a mandatory trigger. And if there is, I guess I'm curious why, but you don't have to answer right now.
Okay, thank you, Jessica. Kelly?
Just a question on H as well, and maybe David can weigh in if necessary. I'm, and this is not a big deal, but why the change from as a going concern to operations? Because this is referring to audit opinions and disclosures, which from an accounting perspective, it's referred to as going concern footnotes. Again, not a huge deal. I'm just curious as to why the change.
Steve, you have a response to that?
Sure, yeah, this is tracking a change that was made in the accounting reporting standards for going concern findings. So the language has slightly broadened and it shifts. There are some responsibilities on the auditor's expression of an opinion about management's assertions, and we're just capturing what we think is the change that was made to make sure it comes within H.
Okay, thank you, Steve. All right, I don't see any more hands on that, and the department has indicated they don't feel they need a temperature check on that. So Greg, you ready to move into 668.174 past performance?
Yes, why don't we move to that?
Hey, Aaron, can you cue that up?
There isn't a lot here either in 174 that we've changed, except you will note in A2, and this has to do with slightly restructuring the sentence to clarify that program review findings must have been for the year or the past 2 fiscal years rather than having a report issued in those years. This is a technical change to conform with how we already read the language. So we'll look at 2 there. In either of its 2 most recent compliance audits had an audit finding or in a report issued by the secretary. It used to say had a program review finding, but that's been taken out. So a report issued by the secretary for its current fiscal year or either of its preceding 2 fiscal years had a program review finding. So the finding keys to the years, and we're not keying to the report. That's the only difference here. So not a big one, but I'll certainly open it up for discussion if anybody has anything they'd like to say about that or questions.
Aaron, can you drop the screen for a minute? Thank you. Barmek, you have a comment?
Yeah, I'm assuming that the language here is incomplete, right? I mean, there are other provisions in this section that.
Well, that's correct, Barmek. We don't as a rule include the entire section unless it's necessary to.
So the past performance of individuals who exercise substantial control is still on the books
Yes.
and tracks this in a parallel to institutional.
Yes, anything that we've rescinded, you would see redlined. You'd see redlined.
Okay, so a couple of thoughts here. It seems to me, first of all, I'm delighted to hear that individuals would still be on the hook because again, you need to change the behavior of individuals to change institutional conduct. And it seems to me that again, this is one of those triggers that may be misplaced way too late in the downward spiral of those actors against whom you would be well advised to act much earlier. So I would strongly suggest broadening the definition of problematic past behavior. One of the problems we saw back in the 80s, which seems to be a recurring issue with the oversight practices at the department, is that people engage in practices that end up costing taxpayers and students enormous sums of money and huge wastes of time. And then they simply regroup under a new banner and do it again and again. And it seems to me that, for example, individuals associated with sizable collapses, that past performance has to constrain their ability to participate in the management of other entities. Again, borrower defense issues, the kinds of bad outcomes that the department would be well advised to prevent repeating in the hands of same individuals under a new corporate banner.
Okay, thank you, Barmek. I don't see any other hands on this, but before I ask you what you want to do, Greg, I want to note that David Sokolow is now at the table representing state agencies instead of Debbie Cochran. So, Greg, where would you like to go from here? Do you want a temperature check?
No, I'm going to move on to one. I don't think we need a temperature check. I mean, we gave an opportunity for comment. Barmek made a comment. It's been noted, and the change itself here is pretty much just a clarification. So I don't think it's anything we have to. It also is codifying current practice. So I don't think it's anything we need to take a temperature check for. I'd like to move on to 175.
Okay.
Alternative standards and requirements. So our first change, just look at what's general here. An institution that is not financially responsible under the general standards and provisions in 668.171 may begin or continue to participate in the Title IV HEA programs by qualifying under an alternate standard set forth in this section. So the first change, we just made a few clerical changes here, but in C, we have clarified in this section that institutions must have remedied any failures to meet their financial obligations in order to use an existing financial protection alternative that allows the school to be considered financially responsible if it provides surety of at least half the school's prior year Title IV volume. So that's in C, financial protection alternative for participating institutions. That is a participating institution that is not financially responsible, either because it does not satisfy one or more of the standards of financial responsibility under 171B, C, or D, or because of an audit opinion or going concern disclosure, qualifies as a financially responsible institution by submitting an irrevocable letter of credit that is acceptable and payable to the secretary, or providing other surety described in paragraph H2 Roman I of this section for an amount to be determined by the secretary, not less than 1/2 of the Title IV HEA program funds received by the institution during its most recently completed fiscal year, except that this requirement does not apply to public institutions. And we note here that for purposes of the failure under 668.171B, the institution must also remedy the issues that gave rise to the failure. And moving on from that, we've nothing under D, E, F, and I'm sorry, we have changes under F. So we're going to go to provisional certification alternative. And we note here that the secretary may permit an institution that is not financially responsible to participate in the Title IV programs under provisional certification for no more than 3 consecutive years if the following standards are met. And we'll go down to, and that, again, this is, Steve did an excellent job of describing this in his comments before lunch. So looking under number 2, under this alternative, the institution must provide the secretary an irrevocable letter of credit acceptable and payable to the secretary, or provide other financial protection described in paragraph H of this section for an amount determined by the secretary to be not less than 10% of Title IV HEA program funds received by the institution during its most recently completed fiscal year. Except this does not apply to public institutions the secretary has determined are backed by full faith and credit of the state. And again, we've inserted to remedy the issue that gave rise to the failure. So that is the change there. And the language mirrors the language we just described about the financial protection alternative. It clarifies institutions must have remedied the failures to meet their financial obligations in order to continue participating in the Title IV programs while not financially responsible. So that is the entirety of what is posed in 175. So I'll take any comments on that before we move on to change of ownership.
Thank you, Greg. Carolyn?
Yes, I generally am supportive of these changes, but I do have a question or suggestion. In the section that deals with alternate means of maintaining eligibility while having failed this financial responsibility, there's a provision that says that this kind of alternative standard is only available for no more than 3 consecutive years. However, BARMAC and others have raised the issue that schools have remained for longer than 3 years in eligible when showing significant financial problems. And I'm not sure, I guess my question is, how is that possible? Are there loopholes or other considerations that we need to be thinking about here? Or is the issue that is it consecutive years being the issue? Because I know that there are a lot of examples of schools that have sort of limped along prior to their collapse for quite some time longer than 3 years. And I'm not sure if it's because they somehow managed to bump up into financial responsibility for 1 year and then back down again, or whether the department somehow permitted them to continue. And perhaps you could shed some light on this, but it seems to me that there may need to be some further modification to ensure that schools are not continuing to limp along on the edge of death for years and years.
Thanks, Carolyn. Steve, you have? Oh,
Yes, I was going to say Steve's a lot more familiar with that than am I, so I'm going to let Steve address that.
Thanks, Greg.
So the short answer is you can participate for no more than 3 years under provisional certification. At the end of that period, the institution can be certified again, and it can be provisionally certified again, even if that's for lack of financial responsibility. So that's how you address the seeming contradiction of there's a 3-year limit, but you'll see institutions that participate year after year after year. And in part, that was because when the financial responsibility regulations were first put in place in the mid-90s, there were institutions that demonstrated they had very good operating histories, but they were very poor. And they were honest enough to say, we're never going to meet your financial responsibility standards, but you can judge us by years of operation that we've met our obligations under the programs. And so the department backed away from an original proposal that would have said after 3 years you had to be financially responsible in order to continue.
Okay. Thank you, Steve. Okay, Greg, I'm gonna, BARMAC?
Yeah, I think look, I absolutely understand the need for the secretary to have some discretion here. In fact, I won't even object to the idea of a 10% threshold for letters of credit under this section, as inadequate as that strikes me as. The problem is that that same leniency that was justified and perhaps was justifiable in certain cases ended up being the path of least resistance for outright fraud that has cost the taxpayers and students hundreds of millions of dollars. And I don't know whether this is something we need to address in regulations. It's more administrative practice. I have a question. Has this, my concern is, draw the line low, but then make case-by-case judgments, both with regard to renewals of the 3-year cycle, as well as with the dollar amount of any letter of credit, and don't let what are intended to be minimum thresholds in the reg become the de facto ceilings on your administrative expectations. I think there have been too many. Has the department really asked anybody that went under for more than 10 cents on the dollar? Do we know that? Do we know if ITT or Corinthian had letters of credit in excess of 10%? That's a question.
Yep. Thanks, Parmet. Steve, you want to address that?
I'll just say there are institutions that have been required to post more than the minimums. There was a long-standing dispute with Corinthian about its financial responsibility structure and whether it met the requirements, I believe. But there are certainly other large institutions that have had letters of credit larger than the minimums, even at the time that they closed.
Okay. Thank you, Steve. I see one last hand up, Carolyn, and then I'd like to wrap up this section and move on to the next. Carolyn?
Just one further thought about the provision with three consecutive years. It seems like it might be against the spirit of the regulation to continue to re-up provisional status after 3 years perpetually, and I would suggest language that makes it clear that that cannot happen in perpetuity. That's not the intention of the strike, or at least seems to me that is, and that would not be a great way to protect borrowers. So I would suggest taxpayers rather. So I would suggest some kind of limitation on the number of years that a school can remain in provisional certification status.
Okay. Thank you, Carolyn. I'm certain the department captured that, but in addition to that, if you have text you would like to submit on that, please feel free to do so. So with that, Greg, how do we stand? Do you want a temperature check on 175?
Let's do that quickly. I'm trying to get one for each major paragraph in which there were changes. So let's go ahead.
Okay.
And do it.
All right. So could we see a show of thumbs on 668.175 alternative standards and requirements? Oh, there you are, Karen. Thank you. I'm not seeing any thumbs down, so we can move on to 668.176, change in ownership.
Thank you, Cindy. Excuse me. So we're going to be move into 668.176. Just as a refresher, and we discussed this earlier when we looked at 668.15. But this is the section where we have incorporated the language from 668.15 that was related to the financial responsibility of institutions undergoing a change of ownership. So those relevant parts of 668.15 have been moved over here with some clarifications to reflect department practice in reviewing financial responsibility for changes in ownership. This is a rather dense section. As you can see, it's all new. So all of it is red line text. We will go through it, but I would ask that, well, I'm going to go through, obviously, A is just the purpose. I'll go through B to C. I would like to keep our comments fairly general in the interest of the time. We do have limited time and a lot to get to. We certainly want to capture any comments, opinions you might have about this, suggestions for improvement, and I would encourage you to do as many of those as possible in writing, so that we can capture them. I certainly don't want to preclude conversation, or if you have a major a point you want to make, but I would ask that you refrain from minor points of clarification, if we can, in the interest of getting through financial responsibility today. So again, these are changes that we that we incorporating what was in 66815. Purpose here to continue participation in a Title IV HEA program during and following a change of ownership. The institution must meet the financial responsibility requirements of this section. And first, we discuss a materially complete application. To meet the requirement of a material complete application as required in 600.20, G2 Romanet 3 and 4. An institution undergoing a change of ownership and control as provided in 600.31 must submit audited financial statements for its 2 most recently completed fiscal years at the level of the change in ownership or the level of financial statements required by the secretary that are prepared and audited in accordance with the requirements in 66823D. The institution must submit audited financial statements of the institution's new owners 2 most recently completed fiscal years that are prepared and audited in accordance with the requirements of 668.23 at the highest level of unfractured ownership or at the level required by the secretary. If the institution's new owner does not have 2 years of acceptable audited financial statements, the institution must provide financial protection in the form of a letter of credit or cash to the secretary in the amount of 25% of the Title IV HEA program funds received by the institution during its most recently completed fiscal year. Or if the institution's new owner has 1 year of acceptable financial statements, the institution must provide financial protection in the form of a letter of credit to the secretary in the amount of 10% of the Title IV HEA program funds received by the institution during its most recently completed fiscal year. And now we move, I just want to clarify here where we say the institution must, we are referring here to the new owner's institution, not the institution being acquired. So we do need to make a clarification there, which we will do, but I wanted to point that out before we move through this. So the institution must meet the financial responsibility requirements. In general, the secretary considers an institution to be financially responsible only if it, for a for-profit institution, has not had operating losses in either or both of its 2 latest fiscal years, that in some result in a decrease in tangible net worth in excess of 10% of the institution's tangible net worth at the beginning of the year of the 2-year period. The secretary may calculate an operating loss for an institution by excluding prior period adjustment and cumulative effect of changes in accounting principles. For purposes of this section, the calculation of tangible net worth must exclude all related party accounts receivable, other assets, and all assets defined as intangible in accordance with the composite score. Second, has, for its 2 most recent fiscal years, had a positive tangible net worth. In applying this standard, a positive tangible net worth, which occurs when the institution's tangible assets exceed its liabilities. The calculation of tangible net worth excludes all related party receivables and other assets and all assets classified as intangible in accordance with the composite score, or has a passing composite score and meets the other financial requirements of 34 CFR 668 subpart L for its most recently completed years. I'm going to stop here for a moment and draw everyone's attention to the way the regulation is written here, that what we just discussed in 3, where we have in 3 Romanet 1 rather, where we have and down in A, where we say that it's these the first 2 or the third, and whether the department would entertain comments as to whether or not it should remain or leaving it to be any one of these, or whether all 3 should be required. So I'll open the floor for comments about everything we've discussed thus far and ask for specific comments related to 3 Romanet 1A.
Okay, Greg, Steve has his hand up.
Yeah, I want to add to what Greg was saying in his explanation. So this is the department's long promised move to take elements that had been in 668.15, update them to incorporate concepts related to the composite score analysis, and then move them into subpart L of the financial responsibility regs. So that's what you see playing out here, where, especially in this section where we've identified 3 conditions that the new ownership of the institution must meet. You'll see that we've got concepts that were in 668.15, but they now include references to adjustments that are routinely made under the composite score, and that would be to remove related party transactions and intangibles from the analysis as well, and including a reference to the composite score calculation itself.
Okay. Thank you, Steve. Barmac, before I get to you, I want to mention that Johnson Tyler has come to the table for legal aid in place of Jessica Ranucci. So with that, Barmac?
So 2 comments, one general and then second one more specific about the section. In the abstract, I don't have an issue with what the department has put on the table here, but the analysis strikes me as a very static one. This is instead of analyzing the change in ownership in motion and understanding that there is a dynamic process by which the nature of the acquiring entity may not fully reflect its superficial markings is important. It's insufficient to take a snapshot of their past conduct and then assume straight line future behavior on that basis, because by the very act of the acquisition, they may well be in the process of morphing into something quite other than what they've been. So I do think that the best way probably to get at that would be to, this is kind of a blunt instrument, but I think it works, would be to essentially prohibit the completely debt-financed acquisitions, essentially leveraged buyouts, and arrangements by which the acquisition is really masking a revenue-sharing arrangement. It's called an acquisition, but it's not an acquisition. It's really a contract for revenue sharing, because there are significant financial constraints imposed on the acquiring entity in the guise of a transfer of ownership. I think that would address that dynamic issue. The more specific comment I want to make is that this language basically lets the publics off the hook because of the inadequacy. Again, the language would have been quite adequate in the olden days where we kind of knew what a public entity is. But now that we have these public entities acquiring various other subsidiaries, some of them quite problematic for profits, it seems to me that you need a whole lot more to ensure that that an acquisition by a public entity doesn't end up being nothing but a reskinning of practices that would otherwise be subject to much different oversight by the department.
Thank you, Barmac. I would encourage you to put any or all of that into the chat, or if you have text, to submit it. Greg, I don't see any other hands, so I think we can, Brad?
This is obviously a lot. So I respect that we're still reviewing it and may have changes prior to the week 2 session. I did just want to clarify 2 things, because there was a suggestion for changing, I think, the wording in 3, that is it going to be the acquiring institution must meet 1, 2, or 3, not the combined entity?
Yes, it's the acquiring institution.
Okay, so we'll insert the word acquiring. Thank you. And then the other thing I just want to clarify too, so to help on my comments, when we're talking about the time frame of the material complete application, I just want to make sure that we understand that the change of ownership could materially improve the institution's financial conditions. We want this to occur if it saves students, save jobs. Again, I understand the intent here. We'll get back to you on comments, but I get the comment. The main comment is we want good students and good people to merge when it makes sense. So.
Thank you, Brad. Okay, I don't see any other hands, Greg.
Okay, so we're going to move, so we're talking about, meeting the financial responsibility requirements in general, and we just discussed what they are for a for-profit institution in A, and then B is for nonprofit, just a change in terms that are relevant to nonprofit institutions, nonprofit accounting, has had at the end of its two most recent fiscal years a positive net assets without donor restrictions. The Secretary will exclude all related party receivables, either assets from net assets without donor restrictions and all assets classified as intangibles in accordance with the composite score. Has not had an excess of current fund expenditures over current fund revenues over both of its two latest fiscal years that result in a decrease exceeding 10% in either the net assets without donor restrictions from the start to the end of the 2-year period, or the net assets without donor restrictions in either one of the 2 years. The Secretary may exclude from net changes in fund balances for the operating loss calculation, prior period adjustments, and the cumulative effect of changes in accounting principle. In calculating the net assets without donor restrictions, the Secretary will exclude all related party accounts receivables, other assets, and all assets classified as intangible with the composite score, in accordance with the composite score rather, or has had a passing composite score that meets the other financial requirements of 34,668 subpart L for its most recently completed fiscal year. And again, we would be asking for any comments on whether currently as written, it would be 1, 2, or 3, or whether it should be 1, 2, and 3. And finally, or for a public institution has its liabilities backed by the full faith and credit of the state or by an equivalent government entity, or for a for-profit or non-profit institution that is not financially responsible under paragraph B3, Romanet 1 of this section, provide financial protection in the form of a letter of credit or cash in an amount that is not less than 10% of the prior year Title IV funding, or an amount determined by the Secretary, and must follow the zone requirements of 175D. So I'll stop there and entertain any comments on the requirements for a nonprofit institution.
Okay, thank you, Greg. Kelly.
Thank you. Just a clarifying question, and it, I don't know if it's the same or different, but when you say the institution must, and we're providing financial statements and recalculating scores, are you looking from a not-for-profit perspective? Are you looking for the combination of the new entity? Because when I think about not-for-profits and I think about change of ownership, the biggest thing that comes to mind is the combination of two, right? So you have two not-for-profit institutions and they're going to combine. I think that's what we've seen in some cases in that area. So is the calculations that we're doing here as it relates to this, the then consolidated institution, which would be the two nonprofits together, or just simply the one that acquired the other nonprofit?
As it's written, I believe that what's in 3, and that includes both A and B for not-for-profit and for-profit, is applicable to the acquiring entity. But Steve, do you want to clarify that? I believe that's what we discussed, but I want to make certain of that.
That's how it's described, but I think this initial evaluation is going to be on the 2 years of audits that are provided by the acquiring entity, and not the newly merged entity that would be created after the acquisition.
Okay, so assuming that the entity that's doing the acquiring is financially responsible, then that's fine.
They should meet this standard, right?
Okay, and then for your question as it relates to and or, I think or would be appropriate.
Thank you, Kelly. Johnson?
Good afternoon. So is more of a question than a statement, because Greg, you keep asking, should there be an and or an or? So I'm wondering whether the acquiring entities usually are passing the composite score, and are the other things kind of superfluous? Why do you keep asking about this? I have no background in the finances of colleges and this sort of thing, but I'm curious what your thinking is.
We're trying to get a feel for, the way it's written is, so they have to, with the or, they have to admit one of the three would be acceptable. Where we will say that, meet the financial responsibility requirements. In general, the secretary considers the institution to be financially responsible if it. So when you look at 1, 2, or 3, there's the option of meeting 1, 2, or 3, or if it read and, then it would be a requirement to meet all 3 of those. So we just pose that as a directed question.
Can I just ask one follow-up, which is, did the GAO did a whole study of sort of the transformation of for-profits and nonprofits? Were these sort of accountability issues raised by them, and did they make some recommendation about greater financial oversight in terms of the change in ownership related to this provision?
I'm not aware of that. I have not. I'm not overly familiar with that GAO report. I don't know if Steve is. If so, he can comment. If not, we'll have to take that back. But I don't want to speculate on that.
Thank you.
Thank you, Johnson. Barmack?
I just want to get some clarification in my head. Am I to understand that the department does not subject the new entity itself that emerges as a result of the acquisition to any of these tests? Because you can have, an entity that has a passing composite score, debt finance a purchase in a way that would put it below that number, I assume, below whatever threshold you pick, no?
Okay. Greg, I see Steve has his hand up. Do you want to defer to him?
Yes, sure. Go ahead, Steve.
So there's 2 things, right? There's the 2 years of audits from the acquiring entity, and those are examined, and the audited same-day balance sheet is examined. So those are all taken into consideration, but probably the better or best measure of the new entity is going to be the audited financial statements of the fiscal year for that combined entity. And you're not going to see that for a year, probably, right? A year plus 6 months, if it's a 6-month submission period. So
Isn't
at
the
the time of the
department-
transaction, you've got the audited same day balance sheet, and you've got the history of the acquiring institution, and those are examined.
Is the department indifferent to the terms of the acquisition itself if it's entirely debt financed, particularly if it's debt financed by the entity being acquired?
I think we would welcome suggestions on that. I know it is a factor that is considered.
I mean, that just blows my mind because, I'd be worried, even if it's a third-party financier, debt financing an acquisition to an otherwise passing, impoverished but passing nonprofit. Now, we can have a separate conversation about the shenanigans with the publics. But particularly when it's sort of like the nonprofit equivalent of a leveraged buyout, where you're essentially being extended credit for money you don't really have to theoretically purchase an entity for hundreds of millions of dollars in some cases, as you know.
Yeah, basically seller finance transactions, right?
Yeah.
Yeah.
I mean, that should be alarm bells should go off all over the department. I'm really stunned that that the department is willing to tolerate that even for 1 year in the interest of getting an audited statement, because on the front end that this thing is a very dangerous financial transaction where a nonprofit is basically handing over future revenues in the form of debt payment to somebody who's now in a stronger position because they used to be an equity owner, now they're a creditor.
Right, thank you, Barmack. In the interest of moving us along, I'm going to turn to Advisor Dave McClintock. I think he has something he wants to weigh in here, and then we're going to move on.
Thank you.
Yeah, I think I have a clarification question for the timing of what's being outlined here. So this is part of the application process for the change of ownership. Is that a correct statement?
No,
This is the first year after the change of ownership.
what you're seeing is there's a requirement in the regulations that the department be notified of a change of ownership no later than 10 days after the transaction occurs. And there's a materially complete application for approval of the change of ownership that comes in as part of that notification. And then there is a supplement to that application that comes in with the state and accrediting proof within 60 days of that. So this is the we're talking about the evaluation that takes place based on this material that comes in following the change of ownership.
But before the opening balance sheet would be submitted, because you have until the month.
Well, that should come in as part of the 60-day time frame.
Right, okay. And then maybe this is the same clarification before, under B1 here, an institution undergoing a change of ownership. That would be the acquiring, the continuing institution, right? Not the institution being acquired. Is that right? Okay. All right, thank you.
Right, thank you. So Greg, you want to move us along here?
Yeah, let's go on to, we'll finish C, and then we can do a temperature check after the end of C, when we will have completed 175.
Okay.
So moving on to the terms of the extension. To meet the requirements for a temporary provisional program participation agreement following a change of ownership, as described in 600.20H3 Romanet 1. The institution provides the secretary with a same-day balance sheet for a proprietary institution or a statement of financial position for a nonprofit institution that shows the financial position of the institution under its new owner as of the day after the change of ownership at the level required by the secretary. The same day balance sheet or statement of financial position must be prepared in accordance with GAAP, published by the Financial Accounting Standards Board and audited in accordance with GAGAS, published in the by the U.S. General Accounting Office. As part of the same day financial statement, the institution must include a disclosure that includes all related party transactions and such details as would enable the secretary to identify the related party. Such information may include, but is not limited to, the name, location, and description of the related entity, including the nature and amount of any transaction between the related party and the institution, financial or otherwise, regardless of when it occurred, and such financial statement must be a consolidated same-day financial statement at the level of the highest unfractured ownership or at the level determined by the secretary for an ownership of less than 100%. Same-day financial statement must demonstrate an asset test ratio of at least 1-to-1. The asset test ratio must be calculated by adding cash equivalents to current accounts receivable and dividing the sum by total current liabilities. The calculation of the asset test ratio must exclude all related party receivables, other assets, and all assets classified as intangibles in accordance with the composite score. Proprietary institution submission must demonstrate a positive tangible net worth the day after the change in ownership. A positive tangible net worth occurs when the financial statement's tangible assets exceed its liabilities. The calculation of tangible net worth must exclude all related party accounts, receivables, or other assets, and all assets classified as intangible in accordance with the composite score. A nonprofit institution submissions must have a positive net assets without donor restrictions the day after the change in ownership. The calculation of net asset without donor restrictions must exclude all related party accounts receivable, other assets, and all assets classified as intangible in accordance with the composite score. If an institution fails to meet the standards of paragraphs C2, 3, or 4 of this section, the institution must provide financial protection in the form of a letter of credit or cash to the secretary in the amount of at least 25% of Title IV HEA program funds received by the institution during its most recently completed fiscal year, or an amount determined by the secretary, and must follow the zone requirements of 175D. And a public institution rather, must have its liabilities backed by the full faith and credit of the state or by an equivalent governmental entity, or must follow the requirements of this section for a nonprofit proprietary institution. And that concludes all of the text for 668.176. So I'll open the floor for any comments or discussion before we move on to 167.
Cindy, you're on mute.
Geez, now I'm guilty of it. Sorry. I just want to remind everyone the department has requested that you keep your comments and questions to major points so that we can get through this. We still have several things to do yet this afternoon. So Barmack?
Two questions or observations. One, I certainly understand the notion of a positive net worth without donor restrictions. I'm just curious whether what do you, again, to just hearken back to the stuff we've seen, let alone the stuff coming at us from in the future. It is not difficult to envision a way of gaming this through a kind of a phantom sale of an entity to an acquiring institution, say for $1, that would have barely any effect on the net worth of the acquiring entity, just $1, but then have significant restrictions that encumber future revenues because the sale, quote unquote, was in fact a revenue sharing agreement disguised as a sale. So I feel like some language may need to be added there. Donor restriction just harkens to the standard legitimate nonprofit practice of soliciting donations from philanthropy and otherwise, and somebody's into, I don't know, ancient archaeology and restricts the donation to those purposes. That's not what we're talking about here. We're talking about revenue sharing agreements that are disguised as transfers of control. So that's one thing. The other question I had for you has to do with this, and we touched on this elsewhere, this notion of full faith of credit of a state or by an equivalent government entity, which shall exclude the acquiring entity itself being the guarantor. But what is this thing about follow the requirements for a nonprofit or proprietary institution? I understand what you're trying to do here. Again, not citing previous examples, but that's pretty loosey-goosey. I think you really need to tighten up the definition of public, not only in terms of finances, but also full applicability of all relevant state laws to the entity qua public. So, and I will try to produce some language for you between the sessions, but I just wanted to flag that.
Thank you, Barmack.
Thank you, Barmack.
Kelly?
Three questions or comments. First, this concept of same-day financial statements, again, is it the acquiring institution or is it the combined institution?
I believe it's the acquiring, isn't it, Steve?
Yeah,
it's written.
So acquiring?
The
Okay.
same day balance sheet post-transaction. There should only be, the acquired institution and the entity acquiring it at that point.
Okay. Second thing is in number two, not-for-profits typically do not categorize or define things as current accounts receivable or current liabilities. So it may just be something to consider based on definition. And then the third thing, number 4, where it talks about the fact that the submission, there must be positive net assets without donor restriction. that kind of goes back to the concept that you had asked about of whether, is it an and or an or as it relates to, positive net assets or current fund, in essence, positive operations versus passing composite score. You could have situations where not-for-profits may not have positive net assets without donor restriction as it relates to movements that they had to make as it relates to MIFA in different states. However, they do have passing composite scores. So in the first area that we talked about, we're saying it's an or, but then in this section, we're saying that that same day balance sheet has to have positive unrestricted net, without donor restrictions, net assets. That may not always be the case.
Okay. Thank you, Kelly. If you want to put those questions in the chat, so that the department can look into that for you, I would appreciate it. Greg, we have no further hands up, so are you ready for the temperature check on 668176 in its entirety?
Yeah, before we do that, we can I just so that we can move on after we do that, I just want to point out that I'll move on to 167. This is severability. This was an existing this is an existing section. It just used to be 176, and we moved when we took the appropriate language, applicable language for change of ownership out of 668.15 and moved it into 176. We moved severability to 177. So that's all that's there.
Okay.
Just want to point that out. We can go ahead with a temperature check, at which point we'll be done with financial responsibility.
Okay. So if I could see a show of your thumbs nice and high on the 668176 change of ownership. Okay, Samantha, I can't see. Oh, okay. All right, I'm not seeing any thumbs down on this, so we can move on. That brings us to starting and hopefully completing change of ownership and starting yet this afternoon certification procedures. But the department needs a quick break here to transition from OGC, their OGC people. So why don't we go ahead, what is it, 2:09? Why don't we say 2:15, we'll be back here and we'll call that good for our break this afternoon, okay? So if we could stop the Welcome back. I want to take note that Donna Mangold is now at the table for OGC. So with that, Greg, I'm going to turn it over to you to walk us through issue paper 5, changes of ownership and changing control.
Thank you, Cindy. And we'll get started with the issue paper on changes of ownership and changing control. And you see the applicable statutory citation and regulatory citation there as well. We'll go into the summary of the issues. We do point out that some of the changes related to changes in ownership are not included in this document. We have the financial standards we just went over. I think they're probably all very fresh in our memories at this point. So a summary of the issues. In recent years, the department has seen an increase in the number of institutions applying for changes in ownership, many of which result in a change in control, and some of which also seek a conversion from proprietary to nonprofit or public status. These arrangements are often high risk. As reported by the Government Accountability Office, 59 changes of ownership from a for-profit entity to a nonprofit entity between January 2011 and August 2020, involving 20 separate transactions, one entire chain, including 13 separate institutions, closed prior to the department reaching a decision on whether to approve the requested conversion to nonprofit status. 3/4 were sold to a for-profit entity that had not previously operated an institution of higher education, increasing the risk that students may not get the educational experience for which they are paying. 1/3 had what the GAO termed insider involvement in the purchasing the nonprofit organization. That is, someone from the former for-profit owner was involved in the nonprofit purchase as well, suggesting greater risk of impermissible benefits to those insiders. Altogether, those institutions total more than $2 billion in a single year. That's award year 18-19 in taxpayer-financed federal student aid. The department has determined, in light of the clear added risk that changes in ownership present, that it is necessary to reevaluate the policies and procedures to accommodate growing numbers of changes in ownership, growing complexity of ownership arrangements, and increased risk to students and to taxpayers if federal requirements for institutions are not appropriately met. So moving to what we're proposing, the department proposes to ensure a clearer, more streamlined process for consideration of changes in ownership, with more robust procedures for ensuring that such changes ensure compliance with the Higher Education Act and related regulations. To achieve these broad outcomes, the department specifically proposes the following. Under 600.2, to clarify the definitions of an additional location, branch campus, distance education locations, and main campus to address existing confusion. To clarify the definition of a nonprofit institution by specifying non-exhaustive examples of certain types of arrangements that are generally not considered to meet that definition, to include an institution that holds related party financing from a former owner of the institution or an institution that enters into or maintains a revenue-based servicing agreement with a former owner. Under 600.4, institution of higher education, we propose to make a technical adjustment to the language that ensures regulatory text is reflective of the statutory language in the definition of an institution by specifying that institutions include public and other not-for-profit institutions. Under 600.20, notice and application procedures for establishing, reestablishing, maintaining, or expanding institutional eligibility and certification. Subsection G, application for provisional extension of certification. We propose to require that institutions undergoing a change of ownership provide adequate notice to the secretary by submitting materials at least 90 days prior to the date of the transaction. We would also clarify the secretary's authority not to approve an institution's participation in the federal aid programs following a change of ownership. Propose to codify existing practice related to the submission of a new owner's audited financial statements. This provision clarifies existing practice of requiring 2 years of audited financial statements. If 2 years not available, financial surety in the amount of at least 25% of Title IV volume, and provides the secretary may require additional financial surety as needed in the amount of at least 10% of prior year Title IV volume. Moving on to proposed changes to 600.20. Notice of application procedures for establishing, reestablishing, maintaining, or expanding institutional eligibility certification, subsection H, terms of extension. We propose to certify to clarify that the secretary is not required to rely on the same terms and conditions of the institution's PPA prior to the change of ownership. This would provide the department with leeway to add additional terms and conditions to the provisional PPA with respect to the change of ownership, regardless of the conditions that were applied to the institution prior to that change. We'd also make technical adjustments to the regulatory language to clarify that following a change in ownership, an institution is placed on a temporary program participation agreement, TPPA. This would be a non-substantive change designed to better reflect current practice. Under 600.21, updating application information. We would clarify the reporting requirements for change in ownership to better reflect the many types of changes in people or entities that may occur and that must be reported to the department, including clarifying when a person, as defined in 600.31, refers to a natural person or an entity. As part of these changes, the department proposes to increase reporting generally by moving from reporting at a 25% change of ownership to a 5% change in ownership to ensure the department has greater visibility into voting blocks and other types of corporate changes that may warrant scrutiny. And under 600.31, change in ownership resulting in a change in control for private, nonprofit, private for-profit and public institutions, subsection C, standards for identifying changes of ownership and control. We propose to make technical changes to the definition of ownership or ownership interest, already included in the regulations to ensure clearer interpretations of when a change in ownership has and has not occurred. We propose to revise the standards for identifying changes of ownership and control for other entities. Many of the reported changes in ownership of at least 25% do not result in a change in control. The department proposes to instead focus on changes that are historically more closely aligned with changes in control, to include changes of at least 50% in control or voting interest, changes in a general partner or managing member, and the addition or removal of any person that provides the financial statements to satisfy financial responsibility requirements in the regulations. And finally, to revise excluded transactions language to allow the department to more easily determine whether a particular type of transaction qualifies as excluded. This paper also refers to changes made in the certification procedures issue paper related to conditions that may be applied to institutions undergoing a change of ownership. So let's start with the actual text, and we're looking at proposed regulations redline for 600.2 in the definitions. So our first change here is a clarification of additional location, and you can see the clarifying text that has been added. A physical facility that is separate from the main campus of an institution and within the same ownership structure of the institution, at which the institution offers at least 50% of an educational program. An additional location participates in the Title IV programs only through the certification of the main campus. We've changed or rather clarified the definition of a branch campus. A physical facility that is separate from the main campus of the institution, is approved by the secretary as a branch campus, and is independent from the main campus, meaning the location is permanent in nature, offers courses in educational programs leading to a degree, certificate, or other recognized educational credential, has its own faculty and administrative or supervisory organization, and has its own budgetary or hiring authority. Another definition that we are looking at here is distance education. And I do want to note that these changes, while not specific to changes in ownership, add clarity to the definitions of an additional location or branch campus. Specifically, we have added language clarifying an additional location participates in Title IV programs only through the certification of its associated main campus. Under distance education, if we look at that, we see in 6, for an institution that offers on-campus programs and distance education programs, the distance education programs are associated with the main campus of the institution. For an institution that only offers distance education programs, the institution is located where its administrative offices are located and approved by its accrediting agency. This is not explicitly related to changes in ownership, but the language clarifies that distance education programs are associated with the main campus if the school offers both online and ground-based programs. If it is only online programs, then again, the institution is located where its administrative offices are located. And we've a definition of main campus that we've added here to align with changes that were included above. The main campus is defined as the institution's located that its location that is certified by the department and the accreditor of the college as a main campus. So looking at the actual language, the primary physical facility at which the institution offers eligible programs within the same ownership structure of the institution and certified as the main campus by the department and the institution's accrediting agency. Also made some revisions to the definition of a nonprofit institution to clarify in a non-exhaustive list what does not constitute a nonprofit institution. This will namely address problems the department has seen in which for-profit institutions seek to convert to nonprofit status, but fail to comply with the statutory restriction that profits cannot inure to any individual. This change clarifies that the department will not consider an institution to be a nonprofit for the purpose of the Title IV programs if it maintains related party financing with a former owner of the institution or affiliate of the former owner that is described in A, or it maintains a revenue-based servicing agreement with the former owner of the institution or an affiliate of the owner that is described in B. And we see that reflected there in 1, Romanet 1, is owned and operated by more than one or more nonprofit corporations or associations, and the secretary has determined that no part of the net earnings of which benefits any private shareholder or individual. And then in Romanet 3, we see is determined by the U.S. Internal Revenue Service to be an organization to which contributions are tax deductible in accordance with Section 501c3 of the Internal Revenue Code, except that for purposes of participating in the federal student aid programs, a nonprofit or institution is generally not an institution that is an obliger either directly or through any entity in its ownership chain on a debt owed to a former owner of the institution or a natural person or an entity related to or affiliated with the former owner of the institution, or either directly through any entity in its ownership chain, enters into or maintains a revenue-based servicing agreement with a former owner of the institution or a natural person or entity related to or affiliated with a former owner of the institution. And we'll stop there. Those are the changes to the definitions, and we will open the floor for any comments or questions related to the definitions.
Kelly.
Just a quick question on the first part of the definitions as it relates to branch campus and these changes. Do you anticipate these changes that anyone would have to go back and have a branch campus approved, or does these changes would the branch campuses fall within this? I guess.
I'm sorry, you're asking whether or not whether we would,
Well, so we've added under branch campus, you've now added is approved by the secretary as a branch campus. Like, are the changes you're making to this definition something that institutions would then have to go back and reevaluate to see if they have to have a branch campus approved, or in most cases, would they already be approved based on the old language?
I'll defer to Donna on that, but I think that currently, I don't think we require every school to go back and resubmit. I think this would certainly be looked at, is generally looked at in a recertification process, but I'll defer to Donna on that.
Yeah, I don't think that there's any intention to resubmit, and I don't think that this also really reflects a change. It just makes it a little bit, certainly just makes it more specific. But these are the concepts that we've been looking at anyway.
Thank you, Donna.
Okay, thank you. Yael.
Thank you. My comment relates to the definition of nonprofit corporations and is based on experience that our office has had with these types of transactions. I'm hoping to make a couple of suggestions that will just clarify the definition in a couple of instances, I think probably aligned with your intention. So first of all, I would add explicitly the requirement that a nonprofit corporation is organized for charitable purposes. Second, I would explicitly add that a nonprofit organization must comply with all state and federal transparency and accountability requirements associated with being a charitable organization. And then my last comment is, in addition to the list of exclusions for the purposes of participating in the federal student loan program, that it not include, that a nonprofit organization not be one where there was a transfer of ownership from a for-profit, where the new entity continues to have significant contractual obligations with the previous entity or any of its owners. So I'll tell you that the context in which I have seen this regularly in a problematic fashion is with long-term leases. And so I think it bears excluding those types of contractual relationships as well.
Yael, do you want to provide any language related to that, or just make
I'm happy to work on language to recommend.
Yes, if you have anything, please share with us.
Yeah.
Thank you. Carolyn?
Thank you. Yes, I wanted to say that I agree with Yael's comments completely, and I have a couple of additional thoughts about the definition of nonprofit. I think that is really crucial to this this regulation, and I think it's a really good thing that the department is looking at this issue and trying to resolve it. I think it's very significant. I agree with Yael that there could be some changes to this section to make the definition of nonprofit work a little bit better here to accomplish what the goal of the regulation is. Most importantly, probably, is that I think that when it's listing the kinds of things that are generally that are not considered a nonprofit, or that would sort of disqualify it from eligibility, that it has to make clear that this is a non-exhaustive list. The issue paper does say that this is supposed to be a non-exhaustive list, but the language of the statute is, the regulation language is not explicit in that. So that would be my first suggestion, is to add something that explicitly makes it clear that this is not an exhaustive list. And then aside from that, I have a few suggestions that I think we would want to include to make sure that as Yael said, when there's a continuing financial contractual relationship that's captured, and that can happen in various different ways. So for example, in 4B, it talks about a servicing agreement, and I would suggest to broaden this so it's not just limited to servicing agreements, but other agreements in which payments from the institution to a former owner are based on revenues of the institution, or otherwise comprise a substantial portion of net revenues of the institution, and be happy to provide some suggested language, and I can work with Yael or others who are interested in this section.
Thanks. We'd be interested in seeing any language you come up with, either in conjunction with somebody else or on your own.
Okay, thank you. Anne?
Sure. I just wanted to lift a question that Jamie had in the chat that I had as well, which is in your comments, Greg, you mentioned that section 6 around distance education is not directly related to change in ownership. So what is the value of this addition, and is there a motivation on the part of the department in including this? Is there a rationale or some challenges you've seen in the past that would motivate you to put that in this particular document?
You're talking about 6, right?
Correct.
Okay. Yeah, for an institution that offers on-campus programs and distance education and distance education programs. Okay, no, okay. I think this goes, as we said, it goes beyond changes in ownership, but I think that it certainly making it clear that for because increasingly you have a lot of schools that are only distance, that where the location of that institution is, that it's going to be the administrative offices, and where that location is, as approved by the department and its accrediting agency, can come into play with any acquisition. We wanted to make that clear. I don't. Beyond that, Donna, do you have any thoughts on that, as it relates specifically to change in ownership?
No, not specifically the changes of ownership. It just because some of the other parts in these definitional changes related specifically to changes of ownership, I think that's why this one got included in this section. It is particularly important to us for purposes of closures. If a main campus closes and then there is an online program, how do we deal with those things in the context of closure? So it has other implications, not just changes of ownership.
So if I could ask a quick follow-up. So are you using this to try to determine where the physical location of the ownership is for that institution?
No.
No?
No, because the physical ownership, it's typically ownership is an entity. And so that entity is organized under state law somewhere. So, and then it has its principal place of business somewhere. So that's what we're looking for in terms of entity ownership. This is more specific to the institution itself. And I just, when these changes were being drafted, this one seemed to be an appropriate thing to put into a definitional change. And we've put them in with changes of ownership for convenience, because most of the other changes in this section do deal with changes of ownership.
Thank you. Johnson?
Hi, I'd like to just applaud the Department of Education for putting together what clearly are attempting to remedy a lot of problems we're seeing out here. A specific point I want to talk to has to do with the definition of a nonprofit institution in section 4, which has what is not a nonprofit. It talks about essentially the original owner making money off of this, but a lot of these owners turn their entities into corporations. There's one owner of a school who told his shareholders that the 80,000 students who enrolled there were creating a profit of 34% of their operating costs, they were making a profit of 34% off of them. So I think the structure is a lot more complicated than certainly what someone who's like myself, who's not involved in finance, in terms of these arrangements. I think you would want to expand this to make sure that the former owner is not just an individual, but a shareholder in a corporations that are running the other entity that may be contracting with the new nonprofit.
Okay. Thank you, Johnson. Brad?
Yes, I'd like to just add to Ann's comment that many institutions offer distance education programs. So this is on point 6. Many institutions offer distance education programs managed out of additional locations and approved by states other than the state where the main campus is located. So is the department indicating or requiring now a change that all distance education must be approved and offered from the main campus, even though that may not be the way the institution is currently organized?
Let me take that back and we'll get a response for you.
And if the answer is yes, and I just wanted to add to that, then what administrative burden that might be to go back to accreditors and states for additional approvals? Anne brought up a great point on that, and I just think it's not the way things are working today, so just need to understand it.
Okay, thanks, Brad. Greg said he'd look at that and get back to you. Barmack?
Yeah, 2 points. The first one relates to what Brad just mentioned. I don't see why the department would leave out state authorization from this definition. State authorization is a much more foundational, formative step in an institution becoming an institution before it even gets accredited. So I would suggest you want to approved by its accrediting agency and authorized by its respective state. That you can take that back. I see how it complicates things, even though I think most states now have reciprocity agreements that should take care of the issue of location of additional locations offering distance ed. The second question I had, I like a lot of what I see here, but I'm a little confused, and it may become more clear as the conversation goes on. What does it mean that the department does not view somebody as generally as a nonprofit? Does that mean that if there were to be an acquisition of a for-profit by a nonprofit, that the department would reject that application? Would it mean that the two entities could, through some sort of legal mechanism, become one, but would then continue to participate in Title IV in their original form? What does that mean, that the department doesn't consider somebody that may have nonprofit status under IRS rules from being considered nonprofit for purpose of Title IV? Do they continue to participate separately?
I'll defer to Donna on that one.
They can participate as a proprietary. If we don't approve them for nonprofit, they would participate as a proprietary.
Would that take care of all of our concerns? Because as you well know, while some of the motivations behind problematic acquisitions may be to evasion of certain specific rules that apply to for-profits, the main motivation, I would argue, is the reskinning of a toxic asset under the guise of new ownership. So I don't know that allowing it to participate, I mean, if you detect somebody is actually doing something that is evasive, that has a purpose of evasion at its core, simply allowing it to go through but continue to participate under differential regulations may not be an adequate response to that.
Donna, do you have anything you want to add?
Yeah, the issue there is that our regulations allow schools to change ownership. We don't preclude the change of ownership. So in the context of a change of ownership that is also request to convert to nonprofit status, we're looking at two things. We're looking at the change of ownership, and we're looking at the request to convert to nonprofit status. So we go through a really holistic, thorough examination of both of those aspects. But so long as the school meets, the financial responsibility regulations, the administrative capability regulations, and there's, you know, we look at those things to determine whether they can continue to participate. If we have situations that are toxic, and we look at whether there are conditions that can ameliorate it. But we look at things in both aspects. So I was a little shorthand in responding to your question when I said they can participate as proprietary. That would be where they would be left in the proprietary status. But if there are suggestions for other things to be looked at in terms of whether the secretary should deny a change of ownership as opposed to just the conversion, I think we'd, you know, send them to us.
Thank you. I want to make note for the record that Debbie Cochran is rejoining the table for state agencies. With that, Debbie, you're up next.
Thank you very much. So I also shared some of the concerns I think that Barmack was getting at with respect to state authorization, and would like to get a little clarity on, in terms of some of these definitional changes, whether the department sees those as having a material impact on institutions, main campuses or branch campuses needing state authorization for Title IV. And then secondarily, on the definition of nonprofit issue, that question, this is something that California has been kind of working through for pursuant to some state laws recently. And I think, you know, I think this is a strong start to be looking at some of these issues. I think that the notion that an institution that did not meet these definitions would then be considered a proprietary institution, which I think is what I just heard, isn't necessarily clear in the language. And I think some of these definitional changes, they do kind of create these odd situations where you have an institution, you know, if an institution is considered a nonprofit pursuant to the IRS, but it doesn't meet this definition of a nonprofit, you know, what is that institution as a core? How do we kind of discuss it? So one way of getting around that might be to think about kind of what are the you know, protections or provisions that are available or applicable to different types of institutions. So if there are particular perceived benefits of being a nonprofit institution, you know, an institution that's Title IV participating would only qualify for those benefits if if they meet the definitions. Just a thought.
Thanks for that, Debbie. Brad?
Yes, on nonprofit item 4, I understand the department's intent and several of the discussions being brought up by this committee on swinging the pendulum back on these nonprofit transactions that have occurred over the past 10 years. With that regard, the revised definition of what is not a nonprofit is still missing any kind of materiality threshold. Many nonprofit institutions of higher education enter into contracts and partnerships with for-profit companies to provide a wide range of services. For example, rent, construction, marketing, hiring a commercial realtor. The fact that a former owner or affiliate may have a small stake in a for-profit company makes the institution a nonprofit may be problematic. For example, if the former owner owns a single share of stock of a publicly traded OPM, and that OPM has a relationship with the school that was sold, does that qualify as an ownership stake? In my opinion, there should be some sort of materiality threshold. A minor obligation of servicing arrangement should not impact a nonprofit status that's been approved by the IRS. Second question, would this be applied retroactively or applied just going forward?
I'd like to encourage you to put, if you have ideas of text on the thresholds, please submit them so that the department can consider them. Jamie.
Handy mute button.
I wonder if the department has in mind, or thinks it would be helpful to have any definitions or guidance about what revenue sharing agreements and servicing are, so that it captures what you mean, but is not confusing. I don't know that there are everyday versions of those, as somebody who's worked with them. For example, would performance bonuses for exceptional performance above and beyond contract terms be covered? And then going back to the exchange between Barmac and Donna, I think Donna's comment was very clear. If the institution were a separate institution, how these would apply to its not getting the department's treatment as a nonprofit under the department's rules. But is it possible for there to be a genuine merger into a nonprofit that met all the tests, or would that carry the same constraint? And you don't have to answer it now. That's maybe a relatively technical question. But in general, the direction of the department being very clear about what its expectations are seems like a positive step.
Okay, thank you, Jamie. Donna, I see you're off mute. Did you have something you wanted to add, or?
No, I thought there was going to be a question, so I was just getting ready.
Well, there was a
Go ahead,
question about
Debbie.
whether there are definitions or what happens if there's a true merger as opposed to a remaining institution that has that kind of agreement.
Jamie, I think that those things as they are now, it's the devil's in the detail of a true merger, and what kind of entanglements remain. And we are looking at these things. We continue to look at them very, very carefully. And so it does the taint necessarily follow? It depends, I guess, is, if by taint I mean, if there are these things that would fall into those categories, we would be looking at them. But then what happens if there truly is a merger? Have those problematic areas been resolved? So it's really fact intensive, very fact intensive.
So so case by case, and you would look at those factors.
Yeah.
In the event of a merger into something that had previously been approved as a nonprofit. Okay.
Thank you. I know that there have been a number of questions posed in this excellent discussion on definitions, and I know a number of those are in the chat. To the extent that the department is able to answer the questions at the moment, they will indicate so. Otherwise, those questions are extracted from the chat, and they obtain your answers and come back to you. So I just wanted to clarify that. All right. Carolyn, you are up next.
Thanks. Two quick points. One is that I recognize this is really a useful discussion and raises a lot of good questions for me. And I recognize this could be a little bit outside of the scope of this, but it occurs to me that one reason that schools do this, and some proprietary schools may do this, not only to not be subject to particular standards, but also to market themselves as a nonprofit, which they may find as advantageous, sort of like for reputational reasons. I wonder whether there should be some clarity that the department would give to schools that do not meet the institutions that do not meet nonprofit definition for how they can talk about themselves in marketing, and perhaps they should be limited to make sure that there's no confusion there. If they're not a nonprofit for purposes of Title IV, they shouldn't be able to tell people that they're a nonprofit, and that people should go there.
We actually do that.
That's excellent. I'm glad to hear that. And I don't know if it's something that needs to be explicit in a reg, but that might be helpful as well.
Thanks, Carolyn. Okay, Greg, I'm seeing no further hands on section 600.2 definitions. You want a temperature check on? Oh, Amanda's got her hand up now.
It's more of just a question to Ed. I was going to write it in the chat, but I'll just make it it'll go faster if I just speak it out loud. For the definition for 600.2 for definition of additional location, I'm not sure if the education department cross-referenced this new definition to how it would impact, align, or match with ongoing negotiations or past regs, or I mean new regs related to prison education programs, but just wanted to like highlight, you know, prison education programs might be impacted by this additional location definition. So just wanted to, hopefully there was some like alignment internally when thinking about this and how it might impact those programs, since there's changes to them with access to federal aid. That's all.
Thanks, Amanda. Greg, I see you're off mute. Did you have something?
Yeah, I think it generally does align. I'm trying to think back to prison education, and I don't see anything which is which would be at odds of what we discussed there. But thank you for bringing it up. But we will look into whether there's any inconsistency there.
All right, thanks. So Greg, do you want a temperature check on 600.2 definitions?
Yes. Why don't we do that? Then we'll move on to 600.4. Thank you.
Okay. So if I could please see your thumbs nice and high, I would appreciate it. Okay, I'm seeing one thumbs down. Brad, anything that you need to add that you haven't stated?
Nothing additional that I haven't already.
Okay, great. Thank you. All right, Greg, so that brings us to 600.4 institutions of higher education. Is that correct?
That's correct.
Okay.
We don't have a great number of changes here. In fact, we just have, you'll note one change here. We have proposed to add the word other to the definition of an institution of higher education. This conforms the regulations to the definition in the Higher Education Act. It also confirms that public and nonprofit institutions are both subject to the restriction that says profits may not inure to an individual in either case. So that's, you can see it, and that's in 600.4A, just where the institution of higher education is a public or other private nonprofit educational institution. And that is the only change that we made for 600.4.
Okay. Any comments on that of major concerns? Jamie? Jamie, you're on mute.
The word other is very confusing. To say public or other private, I'm sure your purpose is well intentioned, but I can't. It feels like it's in the wrong place, or something. You may not. This is not the moment to figure it out, but.
Okay, thank you. Greg, did you want to say something?
No, I think. Well, I mean, I'll take that back. I think it's well. I did explain what we're trying to convey there. But, yeah, I see what you're saying. Do you think the wording is well,
it's similar. How can it be a public or other private? Because publics are by definition not private. It's purely grammatical.
Right.
If I'm the only one who doesn't get it, I will defer to you.
No, I see
with you, Jamie.
I see what you're saying.
Okay. All right. So he's gonna look into that. Greg, what do you want to do with this section?
I don't think we need a temperature check here. It's just pretty much a pro forma change, though, the grammatical aspects of it notwithstanding.
Okay. So how about moving to 600.20?
Yes, let's do that. Okay, we're looking at 600.20. Notice and application procedures for establishing, reestablishing, maintaining, or expanding institutional eligibility and certification. So the change that we're making here requires institutions that are undergoing a change of ownership to notify the department and submit a complete application at least 90 days prior to the transaction. Often the department has received materials at the last minute without adequate time to review the materials, or transactions have changed significantly from the version submitted to the department to how the transaction was actually completed. This will ensure adequate time to assess the change in ownership and determine what financial protections or other provisions may apply to the school following the change. So let's go through that here. If the under the application for provisional extension of certification, if a private nonprofit institution, a private for-profit institution, or a public institution participating in the Title IV HEA programs undergoes a change of ownership that results in a change of control, as described in 600.31, the secretary may continue the institution's participation in those programs on a provisional basis if no later than 90 days prior to the change in ownership, the institution notifies the secretary of the change on a fully completed form designated by the secretary and supported by the state authorization and accrediting documents identified in paragraph G2, Romanet 1 and 2 of this section, and supported by copies of the financial statements identified in G2, Romanet 3, Romanet 4 of this section. And the institution under the new ownership submits a materially complete application that is received by the secretary no later than 10 business days after the day the change occurs. And notwithstanding the submission of the items required in G1, Romanet 1 and 2 of this section, the secretary may determine that participation of the institution should not be approved following the change of ownership. Moving on to G2. For purposes of this section, a private nonprofit institution, a private for-profit institution, or a public institution submits a materially complete application if it submits a fully completed application form designated by the secretary. And we've made changes here to some of the text to a recently updated copy of the institution's state licensure. The remainder of that language remains the same. A recently updated copy of the document from an institution's accrediting association. Under Romanet 4, we have audited financial statements of the institution's new owners' two most recently completed fiscal years that are prepared and audited in accordance with the requirements of 34 CFR 66823 or equivalent information for that owner that is acceptable to the secretary, or if at least 2 years of audited financial statements are not available, financial surety in the amount of at least 25% of the institution's prior year volume of Title IV aid as required in 668.176, and if deemed necessary by the secretary, financial surety in the amount of at least an additional 10% of the institution's prior year volume of Title IV aid, or a larger amount as determined by the secretary. And just to clarify here, this language codifies existing policy, which requires 2 years of audited financial statements from the new owner of an institution, or if not available, financial protection in the form of new owner LOC of at least 25% of the prior year volume. And this conforms with existing policy. And we're also clarifying the department's authority to require additional financial protection separate from the new owner LOC if required. This would be financial protection to reflect the added risk of the institution following the change of ownership. The LOC may be required by the secretary and may total at least 10% of the prior year Title IV volume. So open the floor to any discussions on that.
Brad?
Yes, so just a general comment, I think the most important item in the change of control process is clarity and predictability. In order to plan accordingly and ensure transactions are successful, parties need to understand what the department is going to evaluate, the thresholds that must be met, and the consequences if they're not met. We're generally supportive of efforts to achieve these goals. Second, the parties need the department to be able to process pre-acquisition reviews as efficiently and timely as possible. The department lately has been taking a long time, 6 to 12 months, to conduct these reviews. Does the department have the authority to charge the institution fees to get comprehensive reviews conducted on a more expedited timeframe? I think institutions would consider paying reasonable processing fees if the department in exchange would commit to completing a comprehensive pre-acquisition review in a quicker, certain time period. Question one. And then question two, is the mandatory pre-closing filing proposed in 620 G 1 Romanet I a pre-acquisition review, or does this serve a different purpose? If so, does it fit into the pre-acquisition review process?
Want to address that, Donna?
I'll address the last question, which is what function does Romanet I serve? The purpose for that is oftentimes schools, we're finding that schools go through with changes of ownership or go through with transactions that they believe are either excluded or don't constitute a change of control. And then we're caught in a situation where they notify us of a change and haven't met the requirements of a materially complete application with 10 business days. So this kind of any kind of change would need to be reported to us 90 days in advance. The other issue is that oftentimes these require a new owner letter of credit, and we're finding situations where schools change ownership. A new owner letter of credit is required, and either the school or its council doesn't realize that. And so this gives a chance to get ahead of fire drill situations where schools actually could lose eligibility. Because if a school changes ownership, it loses eligibility under 600.31. It can continue participating if it complies with G, and then later on we'll get to H. But there are situations where schools are not prepared to comply with G, and therefore they lose eligibility. This is what we're trying to avoid. We're trying to get ahead of it. So this is not married to a pre-act review.
Okay, that's what it's not tied into the pre-acquisition review. Thank you. And then on the processing fees, have you had a chance to think about whether or not the department has that ability to charge fees in exchange for more timely reviews?
That is something that we have begun to look into, and we would be happy to entertain any ideas that any of you would have about what might be appropriate there.
Okay, Barmack.
Couple of questions, one of which has to do with whether 90 days is adequate notice, given some of the complexities here. The department, for example, gives itself, I think, 180 days to review borrower defense applications. These transactions are probably vastly more complicated and consequential than borrower defense applications. So whether 90 days is enough, I don't know. I just want to make sure that it is. It sounds to me like the department is facing a too big to fail phenomenon where, it's confronted by fact on the ground that it has to accommodate because the deed is done and the department is placed in this impossible conundrum of either cutting off the school and creating disruptions or taking the blame for them. So you may want to give yourself more latitude on that front. And I'm concerned with this notion of 10 business days after substantial changes may occur. I mean, it could be done 10 days before the acquisition. The terms of the deal could be significantly different from the terms you reviewed, and the acquisition could go through nevertheless. It seems to me like there ought to be a reset if there is a significant enough change that would alter the criteria on the basis of which you may have reviewed an entity. And then with regard to letters of credit, is the dollar amount of the letter of credit tied to the acquiring entity's prior year? Because the thing, of course, we're all worried about is a tiny little fish illegitimately swallowing a big fish. It's a tiny little fake nonprofit acquiring a very large for-profit business to evade bad publicity or reputational damage or regulation. So tying it to the prior years, I hope it's the combined Title IV funds for the two institutions, not just the acquiring institution, because the acquiring institution could be an impoverished little college that has really no legitimate way of acquiring the bigger entity on the up and up.
Well, quick announcements. Emmanuel is coming to the table, as well as Jaylon Herbin. So welcome. Jamie? You're on mute, Jamie.
I thought Emmanuel was ahead of me, but your call.
No, well, yeah, he's just joining now, so he'll get in queue.
It would help me and maybe others if, Donna, you could explain the relationship of the at least 90 days in advance notification of a change in ownership that's planned and to Romanet 2, the accrediting association's copy of the document about accreditation. Are you asking what, and I realized only a little of this is new, but the 90 days is a change. What is it that you are expecting from the accrediting agency at that point? That the transaction is approved by us, or that this institution is accredited now, and then separately that the transaction will be reviewed? How do those two relate?
Okay. Romanet 1, the 90-day requirement, is not a review of the transaction. It's simply, think of it as an early alert. Many schools give us lots of heads up. They say we're going to do this. These are the new owners. They either want, they want some sort of a pre-acquisition review. We send out an exhaustive document request letter. They comply. We review. It's a very complex process. This is a heads up. We're going to change ownership, and what we also give us, and there will be a form to give us sort of basic information, because what we're trying to avoid there is a situation where you need a new owner LLC potentially, and you've gone through your transaction and you're not prepared to get a new owner LLC. And then the requirement for the accrediting agency, Jamie, is just it marries the G requirements, which are not the approval of the change of ownership, but simply that you are accredited and you have state authorization. So that we know you at least meet the initial requirements that you're going to have to meet 10 business days after you change.
So you would know the accreditation status, and that would also give you a chance, if there were a concern or a sanction, to get a fresh indication of that while you're looking at the heads up.
Yeah.
Okay.
But this is this is basically early alert. We're going to do this because we find out about things after they've happened, and then it's trouble.
Thank you, Jamie and Donna. Jaylon?
Thank you. So my question really is, Donna just alluded to that this is sort of like a warning pretty much for the institution to get to the Department of Education. But going back to Barmat's question, I still don't believe 90 days is enough time. If you think about the student protection, what takes place during that time to protect the students during the change in ownership before and after? So what happens if something falls through the crack and they don't meet that requirement for the change of ownership? Then how are the students going to be protected by the Department of Education during this time? So I think I would like to keep that as a focal point as well.
Great, thank you. Brad?
Thank you. Just going back to Romanet 1 here, which looks like now may mandate pre-acquisition reviews. I know in the past, pre-acquisition reviews have always been advisable, generally recommended for all the reasons Donna Mangold just suggested. But based on Section 498, where is the authority to mandate a pre-acquisition review in all situations?
It really,
the risk of not submitting a material complete change of ownership application within 10 days is on the institution. We'd support the department making the risk of failing to do a pre-acquisition review better known to all institutions, particularly private nonprofits that may not be familiar with those requirements.
this is not a mandatory pre-acquisition review. It's just not. It is, we want to make sure you are accredited. We want to make sure you have state authorization, and we want to make sure that we know enough about this transaction to let you know if you need a letter of credit. You know, the alternative is we end eligibility for schools who walk into a trap in terms of not having proper advice, just not knowing, and they change ownership, and 10 days goes by and they cannot meet those requirements. So this is not a mandatory pre-acquisition review. At least that's certainly not the intent of this.
Thank you.
Thank you. I want to make note that Kelly Perry is back at the table for private nonprofits. Welcome back, Kelly. Greg, I'm not seeing, oh, Brad's got his hand up again.
Yes, ma'am. Sorry, I didn't intend to go back to back, but I did want to move to Romanet. I believe it is 5, although it's marked out. The additional 10% financial surety. The question to the department would be, what criteria would the secretary use to determine if a financial surety or letter of credit that is larger than an additional 10% of Title IV is needed? It seems to be intentionally open-ended to give the department maximum flexibility. And could it be capped at 75% to 100%? You know, I'd like to have the department have some justification, bullets as to actions that would impose a surety above 10%, give the institution opportunity to give the institution an opportunity to respond before it becomes effective.
Thank you.
All right. Thanks, Brad. All right. I'm not seeing any more hands, Greg. Did you want a temperature check on 600.20G?
Yeah, let's take a temperature check on G.
Okay. All right. So 600.20, could we, on subsection G, if we could see your thumbs, please? Okay, I see one thumbs down. Anything to be added? Okay. All right, Greg, you want to move on to section
H.
H.
So moving on to section H, terms of exclusion. And the first change there is in H1. If the secretary approves the institution's materially complete application, the secretary provides the institution with a temporary provisional program participation agreement, or TPPA. The change there conforms the references to the PPA to instead refer to the temporary provisional PPA, which is what the department currently offers to institutions following a change of ownership. So this recognizes current practice. The next change there is in 2. The TPPA expires on the earlier of the last day of the month following the month in which the change of ownership occurred, unless the provisions of paragraph H3 of this section apply. The date on which the secretary notifies the institution that its application is denied, or the date on which the secretary co-signs a new provisional participation agreement or PPA. And this language simply flips the order of 1 and 3 to reflect the chronology of these events. Moving on to 3, the TPPA will expire under the provisions of paragraph H2, Romanet 3 of this section. The secretary extends the provisional TPPA on a month-to-month basis after the expiration date described in paragraph H2, Romanet 3 of this section, if prior to that expiration date, the institution provides the secretary with the financial aid information required in 34 CFR 668-176. That's in the financial responsibility section we just reviewed. And because of that cross-reference, the text in Romanet I is no longer deemed necessary. And those are the changes for H and the entirety of 600.20. So we'll open the floor for discussion on that before we move to 600.21.
Okay, thanks, Greg. Carolyn?
Just wanted to offer some support for the change that the department is making to omit language that would have required the department to apply the same terms and conditions to a provisional PPA. That doesn't make sense. The change makes sense, and we are supportive of it to permit the department to impose conditions where it's necessary to protect taxpayers.
Thank you, Carolyn. Kelly?
In 3, should the reference to paragraph H2 Romanet 3 be Romanet 1 because you made the switch, or is that still appropriate the way that that reads?
You're correct. We'll make a note of that.
We need to change that.
Thank you, Kelly. Ann?
Just another sort of language question. In 2.3, it goes back to saying provisional rather than temporary provisional. So should it say until another temporary provisional is assigned, or what's the distinction between temporary and temporary provisional if it's really supposed to be two different things?
Can you address that, Donna?
Sure. When the institution changes ownership, assuming they comply with the 10-day requirement of materially complete application, we can issue them, typically what we do is we issue a temporary provisional program participation agreement. Then as long as they meet H, it continues month to month. When we actually approve the change of ownership and impose any, if there are any conditions, we then issue a provisional program participation agreement. Those provisionals following a change of ownership are governed by 668.13. So the regulations as currently written referred to both kinds of participation agreements as provisional program participation agreements, but the piece of paper that schools actually get following a change of ownership and that continues them in participation until we actually approve or disapprove is titled temporary provisional program participation agreement. So that distinction there, using temporary and then not using temporary, is correct and intentional.
Okay, thank you.
Okay.
I'm sorry, Greg, I don't see any further hands. Do you want a temperature check on H? Oh,
Yes.
Barmack. Barmack's got his up now. Hey, Barmack.
Sorry, I did it behind your back, Cindy.
You did.
Tried to get one past the goalie. So I just want to point out that part of the challenge here is that the department is attempting to sort of like landing a 747 and a Cessna 152 on the same, at the same airport. I think 90 days may be perfectly reasonable for pre-acquisition review. The department may be able to very quickly take care of it and be done. I worry that could be entirely inadequate for purposes of satisfying a proper review of complex ownership changes, the ones that we should all worry about, as a consequence of which they could comply with the 90-day provision of information. Things could change very substantially in the interim. They can even comply with that. And we would end up with this month-to-month TPPA for a fairly extensive period of time before the department could really decide that the acquisition should not be approved, that continued participation should not and would not have been approved had it had enough time to review the terms of any arrangement. So I don't know what the solution is, but it seems to me that we're sort of writing one size fits all here, that you may want to mandate a longer period of notice or additional conditions associated with more significant dollar amounts at risk.
Okay, thank you, Barmack. Greg, okay to do the temperature check on 600.2H?
Yes.
Okay, let's see your thumbs, please, on 600.20H. Ashley, I can't see yours. Oh, there you are. Okay. All right, it looks like there are no thumbs down, so that's a good thing. So we're gonna now move into 600.21. I want to note to the committee that we have approximately 1/2 hour before public comment, and I would encourage you to get through the rest of this issue paper, 600.21 and 31, because you are going to have a full agenda tomorrow between certification procedures and 9010. So with that, Greg, you want to move us into 600.21?
Sure. So we're looking at updating application information here, reporting requirements, except as provided in paragraph B of this section. An eligible institution must report to the secretary in a manner prescribed by the secretary no later than 10 days after the change occurs of any of the following. And then we move down to where the changes are here. We have throughout the section added language to clarify when a person refers to a natural person versus a legal entity, since both are currently included in the definition of a person in the regulations in 34 CFR 600.31. So starting with 6, a natural person or legal entity's ability to affect substantially the actions of the institution if that natural person or legal entity did not previously have this ability. The secretary considers a natural person or legal entity to have this ability if the natural person acquires alone or together with another member or members of his or her of their family at least a 25% ownership or voting interest in the institution, direct or indirect, as defined in 600.31B. The entity acquires alone or together with an affiliated natural person or entity at least a 25% ownership or controlling interest in the institution, direct or indirect, as defined in 600.31B. The natural person or entity acquires either alone or together with another natural person or entity under a voting trust, power of attorney, proxy, or similar agreement, at least a 25% ownership or controlling interest in the institution, direct or indirect. Or the natural person becomes a general partner, managing member, chief executive officer, or chief financial officer of the institution or of an entity, which has at least a 25% ownership or controlling interest in the institution, direct or indirect, as defined in 600.31B. Or the entity becomes a general partner or managing member of an entity which has at least a 25% ownership or controlling interest in the institution, direct or indirect, as defined in 31B. Then we move on to changes in 14. In addition to the reporting required by paragraphs A6 and B of this section, any change in the ownership of the institution that does not result in a change of ownership as described in 600.31 and subject to the requirements of 600.20 G and H, including the addition or elimination of any entities in the ownership structure, a change of entity from one type of business structure to another, and any excluded transactions under 600.31E. And this provision adds that the institutions must report any change in ownership that does not result in a change in control, such as changes in the ownership structure or the entities involved or excluded transactions. And then in 15, in addition to the reporting required by paragraphs A6, A14, and B of this section, any changes in the ownership of the institution, any change in the ownership of the institution, rather, that does not result in a change of control as described in 600.31 and subject to the requirements of 600.20 G and H, whereby a natural person or entity acquires at least a 5% ownership interest, direct or indirect, in the institution. And this provision lowers the threshold for reporting new acquisitions in ownership from 25% to 5% ownership interest in the institution. This allows for greater department insight into the changes in ownership that may be occurring and will allow the department to assess whether changes in combinations of owners may constitute a change in control. So we'll leave it there and open the floor for comment.
Anyone? Here to comment? Barmack.
So, couple of thoughts. One of which, again, I understand the 25% threshold in the case of small businesses. It is entirely inadequate for purpose of understanding who controls a publicly traded corporation. Beneficial ownership is threshold under SEC rules is set at 5%. Insiders are defined as folks who own 10% of shares. So you may want to separate that because that's a fairly high threshold for the vast majority of corporations. There are very few publicly traded corporations in this space where any one entity owns 25% of the shares. What is lacking here, just again addressing past abuses, is creditors. What do you do when somebody has extended so much credit to an entity that without necessarily being on the board or being an officer or director of the entity, they can basically call the shots as privileged creditors of that entity? Seems to me like we need to do something with regard to that, and also ensuring that you don't end up with fractured ownership where friends and family together, each of them below the threshold, but together actually exceed the threshold.
Thank you, Barmack.
Thanks, Barmack. Johnson?
Yeah, I would just like to add, I once had to study a case involving a for-profit in our city of New York, and basically 4 people in the company sold a lot of stock to investors and then sold it like 3 days later and made a huge profit. And the case ended up in federal court. That's how I learned about it. So I want to echo what Barmack said, that there are a lot of people involved in more than simply family members who may be the shareholders here who need to be scrutinized. So I appreciate the idea, the goal here. I feel like you need lawyers who specialize in this sort of insider dealing to really understand all the permutations of it to make sure we're covering everyone.
Thank you, Johnson. Greg, did you have something to say? Okay.
Oh, no.
All right, great. Anyone else? If not, I think we can move to temperature check on 600.21. Could I please see your thumbs? Amanda, I can't see yours. Thank you. All right, there are no thumbs down. Greg, you want, thanks. Greg, you want to move us into 600.31?
Sure. So we're moving on to 600.31, change in ownership resulting in a change of control for private, nonprofit, private for-profit, and public institutions. So our first change here comes under B, definitions. The following definitions apply to terms used in this section. And see here under a closely held corporation. Closely held corporation, including the term close corporation, means a corporation that qualifies under the law of the state of its incorporation or organization as a statutory close corporation, or if the state of incorporation or organization has no close corporation provision, a corporation, the stock of which is held by no more than 30 persons and has been and is not planned to be publicly offered. We move down to a change in 2. We proposed this change simply to clarify that the language and interpretation of determining whether to clarify the language rather, and interpretation of determining whether changes in ownership have occurred. This clarifies that changes at the top of the entity constitute a change in ownership. For purposes of determining whether a change in ownership has occurred, changes in ownership of the following are not included. So just changing what's in 2 and retaining what is below that. And we simply clarify here the language and interpretation of determining again whether those changes in ownership have occurred, and clarifying at the top, clarifying the changes at the top may constitute a change in ownership rather than acquiring one of these examples. Moving on, there are changes in other entities. 3 other entities. The department has proposed changes in this section to when we consider a change in ownership to also result in a change of control. While the current threshold is 25%, the department's experience is that most changes in control occur at or above 50%. Accordingly, we have deemed a change in ownership to result in a change of control if the change is at least 50% control interest in the institution. Coupled with the above reporting requirements that have lowered the reporting threshold from 25% to 5% ownership interest, we believe this will allow the department to focus its resources on institutions that require the greatest attention, without sacrificing a review of institutions that fall below that level. So we'll look at the actual changes there in 3. The term other entities means an entity which is not closely held or required to be registered with the SEC, and includes limited liability companies, limited liability partnerships, limited partnerships, and similar types of entities. Secretary deems the following changes to constitute a change in ownership resulting in a change of control of such an entity. A person or combination of persons acquires at least 50% of the total outstanding voting interests in the entity, or otherwise acquires 50% control rather. A person or combination of persons who holds less than 50% voting interest in the entity acquires at least 50% of the outstanding voting interest in the entity, or otherwise acquires 50% control. A person or combination of persons who holds at least 50% of the voting interests in the entity ceases to hold at least 50% voting interest in the entity or otherwise ceases to hold 50% control. A partner in a general partnership requires or ceases to own at least 50% of voting interests in the general partnership or otherwise acquires or ceases to hold 50% control. Any change of a general partner of a limited partnership or similar entity if that general partner also holds an equity interest. Any change in a managing member of a limited liability company or similar entity if that managing member also loses an equity interest. A person acquires or ceases to hold 100% or equivalent direct or indirect interest in the institution, or the addition or removal of any person that provides or will provide the financial statements to meet any of the requirements of 34 CFR 600.20G, H, or subpart L of 668. And the Secretary deems the following interests to satisfy the 50% threshold described above. And this section further clarifies that control does not need to be through a single individual or entity, but can occur in certain combinations of individuals. So looking at this, a combination of persons, although each with less than 50% voting or controlling interest in an entity, hold a combined voting interest of at least 50% as a result of proxy agreements, voting agreements, or other agreements, or by operation of state law. A combination of persons, although each with less than 50% voting or controlling interest in an entity, hold a combined voting or controlling interest of at least 50% as a result of common management and control of that entity, either directly or indirectly, or a combination of individuals who are family members as defined in 600.21, although each with less than 50% voting or controlling interest in an entity hold a combined voting or controlling interest of at least 50%. And notwithstanding the foregoing, if a person alone or in combination with other persons, as described in paragraph C3, Romanet 1 through 3 of this section, has less than a 50% voting or controlling interest in an entity, the Secretary may determine that the person, either alone or in combination with other persons, has actual control over that entity and is subject to the requirements of this section. Any person alone or in combination with other persons has the right to appoint a majority of any class or board members or an entity or an institution is deemed to have control. And this language adds that the Secretary may deem change in control to occur below 50% if he determines that another individual with less than a 50% interest in the institution does have control over the institution, or an individual or a combination of individuals has the right to appoint most of the board members of the institution and has control of the institution. You see language eliminated below that. We have eliminated this language because we do not believe it necessary given the changes above. The additions reflect these situations. And that covers it for C. So open the floor for discussion or comments related to paragraph C.
Okay. Brad.
Yes, so this comments in other entities, Romanet 2. I just want to state for the record that this, I'm not a corporate lawyer, and these are some complex things here. So we're still thinking about this, and if I have any language changes, we'll send them to you. I did want to ask Donna, the department on G. I thought I remember there being a threshold in the past around 100% owner, not maybe it was 5%, maybe 25, I'm forgetting, but not requiring a change of ownership. Is there any thought around G? Is it if a person goes from 100% owner to 99% owner, that's a notification. Am I reading that correctly?
I'll let Donna respond to that.
Yeah, let me take a look. Now, and maybe we need to look at the language. It would be, we're really focusing on someone who, an entity, a person who acquires 100% interests, for example, like a sole member of an entity, or then relinquishes that. You know, a lot of these provisions here are to sort of avoid some of the debate back and forth as to control, not control, that these are presumptions about control, but no, we're not talking about 100 to 97. So we probably have to take a look at, you know, it seemed to be clear when we wrote it, but maybe we have to take a look at the language.
I read it, anything other than 100 required notification.
Yeah.
Thank you.
And this, you're not in it's not in the notification provision. Right now, we're actually in what is a change of ownership resulting in a change of control. So that's what we're talking about here.
Okay, Greg, I don't see, Barmac.
Making sure you're paying attention, Cindy. Honestly, my eyes glazed over when I saw this language, and I don't know that I know any. I think I know less now than I did before this explanation. I'm struggling to understand where in this section we define which specific combination of natural persons we are talking about when there is a shift above that threshold of 50%. Because I mean, ownership can change, and there's always a subgroup of, you know, of the 100% of equity in any corporation, some subgroup will own half of it. Is it any random pair? Is in other words, is the combination of any random grouping we're talking about, or are we attempting to identify a group that have a business affiliation with each other who then together cross that threshold?
That's correct. And the other thing is,
where does it define what that relationship is?
Well, we say it pretty broadly. We talk about voting agreements, we talk about family relationships, we talk about proxies, and you know, it would be, you know, it's a person or combination. Let me take a look again. Over in 3, where we, in Romanet 2, we talk about a combination.
Right.
And then Romanet 3, we try to explain what a combination might look like. And so it would be proxy agreements, voting agreements, other agreements, so that it's not just random groups of people that you have 50% leaving at some point. That 50% would have had to be in control, and now they are no longer in control.
So if there is a gentleman's nod to work together without signing an actual agreement, are we letting them off the hook?
There is, well, you know, we have to do these things based on documents and evidence. And in terms of the amount of time it takes us to do this, the amount of resource it takes to do it, getting behind a gentleman's nod would be tough. You know, sometimes we see other, you know, we can find out, because we do our research, of other relationships. You know, there may not be a signed paper, but we know people have been in business before. So we ask a lot of questions, and this, you know, every gentleman's nod, person's nod, we may not catch. We probably won't catch most of them, but you know, to the extent in particular that we know of schools and we know people who have been involved in schools before and we know of those relationships, we can look at, we will be looking at those things.
I appreciate that answer and I understand it, certainly. But I would encourage the department to think creatively about putting some catch-all somewhere that at least post facto, because I understand you can't go investigating everybody on the front end to see who knows who, but there ought to be something post facto that allows the department to constructively suggest that people were acting in concert with each other despite the absence of any written agreement. And the reason is that in the worst possible cases, fraudsters generally don't execute, formal contracts with each other. And that's the danger we're attempting to fend off here, at least again, on the back end.
Thank you, Barmack. Brad, you're next. Emmanuel Gilroy's coming to the table with a question. And then after those two, I think I'm going to ask Greg to walk through the very last change for this. And I would like to get to a temperature check on this document to complete this issue for today, clearing your path for tomorrow. Okay?
Thank you.
Brad?
Thank you, Cindy. Just another quick clarifying question for Donna. Do the standards that we're talking about here in 3 other entities apply equally to private nonprofits and controlling organizations? For example, would a religious order or nonprofit foundation that operates a college subject to the same test?
There is no distinction here to the status as proprietary or nonprofit.
Thank you. Emmanuel?
I had a quick question as it relates to nonprofit governance and our board structure. And so it kind of builds on what Barmack was asking when it comes down to the combination of persons. And so I appreciate the answer that you gave on page 12 and kind of pointed us to Romanet 3 and how you're defining, in some ways, the combination of persons. But at the same time, like on a board of 12 people per se, I guess that combination of persons would be, we don't know. I guess the exact number, it would have to just kind of correlate to what you have outlined here, which could be the result of proxy agreements, voting agreements, other agreements, or the result of common management and control of that entity. I just think for us, we just want to be able to understand that a little bit better. And then the other thing on page 12 is an H. Could that be a CFO being removed from an institution? Like, would that qualify, since you have here the additional removal of any person that provides or will provide the financial statements to meet any other requirements? So I guess some clarification there too.
And part of this is that we don't have the entire regulation printed out here. So in 600.31, there's the definitions of the word person means both a natural person and a legal entity. So this 31 is a little bit different. That's why we had to specify it in 21. But this does not mean the addition or removal of a CFO. This means the addition or removal of the entity at which level the financial statements are provided. The level that the entity that provides the financial statements. And then as to your other question about changes in board membership, we're not talking about changes in board membership because those don't constitute a change of ownership. The threshold here is a change of ownership that results in a change of control. So movements among boards, whether they stay the same or whether there's movement, is not what we're looking at here.
Okay, thank you.
Thank you. Okay, Greg, can you walk the committee through that very last change?
Certainly, be glad to do that. So we're looking at D, covered transactions. We see, I'm sorry that there are no changes there. We're moving on to E, excluded transactions. And making the point here in E3 that we have revised this language to provide clarity to the field and to the department. While retirement can sometimes be difficult for the department to assess, resignation and transfer is a more straightforward concept to implement. We do not believe this makes any substantive change to the meaning of this language. So I'll just read it here. So it's upon the resignation from the operation of the institution by an individual owner who has been involved in the management of the institution for at least 2 years preceding the transfer, and who has established and retained the ownership interest for at least 2 years prior to the transfer to another individual owner with direct or indirect ownership interest in the institution, who has been involved in the management of the institution for at least 2 years preceding the transfer, and who has established and retained the ownership interest for at least 2 years prior to the transfer.
Okay, so with that, any comments on that? Can we stop sharing things? Barmack.
Yeah, under covered transactions, you may want to kind of take another look at the most current practices that ought to be alarming to all of us. So I would consider something along the line. It's not transfer of assets is one thing, but transfer of significant or commitment of significant future revenues should be another covered transaction that for all intents and purposes could in fact be equivalent to a change of ownership. If you're encumbering, 50% of your future revenues pursuant to an agreement with an outside party, you may well have handed control of the institution to that party. It's not just transfer of assets.
Thank you, Barmack. I want to note that Kelly Perry has rejoined the table. Greg, did you have something, or are you good?
No, I'm good.
Okay, Jamie?
Yes, can you explain the relevance of the 2-year issue in number 3?
I'll turn that one to Donna if she can address it.
She gets all the hard ones, always.
Yeah, she does. When it comes to this topic, yes, she's going to get the hard ones.
I do want to remind you we're 2 minutes from public comment.
2 minutes, 2 years. Jamie, that was in the original language and so what we did here, it said it had to do with the retirement of a person, and you can see in the text that hasn't been changed, it talks about 2 years of the person who had been involved. So is your question whether, we wanted to make sure that there was at least some investment in management of the person who's transferring stock, so for that reason, we put it at 2 years. Maybe it's 5 years, maybe it's 10 years. If there are other, it was just matching the language as to the person who would be acquiring the stock or the interest. So if there are suggestions for maybe making that period different, we'd be open to look at that.
I'll do it in writing offline.
Thank you.
Great. Thank you. All right. With that, I would like to see your show of thumbs on a temperature check on 600.31, the entire document. All right. I'm not seeing any thumbs down. Great job today, committee.
Thank you, everyone.
All right, with that, Brady, can you start letting in our public commenters, please?
Yes, ma'am. I just submitted our first speaker, who is Mr. Sean Bronstein, who's a veteran representing themselves.
Hi, Mr. Bronstein. You will have you have 3 minutes to speak, and that 3 minutes will start when you start speaking. Welcome.
Thank you. Good afternoon. My name is Sean Bronstein. I'm an Army veteran and recipient of educational benefits that I earned while serving our country on active duty. I'm here to tell my story in the hope that you ensure that other veterans and students do not experience what happened to me at Hesser College. After I left service, I was immediately bombarded with advertisements, mail, and phone calls from colleges. I wanted to use my GI Bill benefits to pursue a career in the medical field. One of the schools was Hesser College, which was owned by Kaplan. This school interests me because it was nearby, offered a medical assisting program, and promised me that I could use my GI Bill benefits for my education. They recruited me hard by continuing to call me until I agreed to meet with them. When I met with them, I didn't even fill out an application. They admitted me on the spot. The admissions rep told me that classes would start the following week, and if I didn't sign up that day, they would fill up and I would miss out. The rep also guaranteed that based on my experience and my new degree that I would earn, that I would get a job after graduation. Facing life as a civilian with a mountain of medical issues, including a traumatic brain injury I sustained, I felt lost in a world of unknowns. I felt a lot of pressure to start right away and was promised that the school had high quality programs that would lead to great jobs for veterans like me. Most importantly to me, the admissions rep promised that the GI Bill would cover everything. I believed what they told me, so I signed up that day. Then the problems started. The financial aid office told me that the GI Bill took too long to come in and I would have to take out loans to cover tuition or risk being dropped from all classes. They also told me that my benefits did not cover all the tuition and books and extra loans were required. That didn't make sense, but I trusted them. I wasn't learning much, and when they made promises to me to accept credits and work experience I had earned, but then didn't deliver it, I switched my degree major to criminal justice. I worked hard and graduated with my bachelor's degree, but could not find a job in criminal justice. The school never provided job placement services, resume critiquing, and despite promising a guaranteed job after graduation, I again was lost. But at that point, I had $50,000 in student loan debt, despite being told that the GI Bill would cover everything. My degree from Hester was completely worthless, and the loans dragged me down for years. I even went into default at one point because I didn't have a job and could not afford the payments. Years later, in a ball of red tape, I was able to have my loans canceled through total and permanent discharge disability. This discharge that was given to me. Say again?
30 seconds, continue.
Thank you. This discharge that was given to me actually hurt me, and as it counted as a significant income on my taxes and eliminated a tax refund that I desperately needed and counted on. To add insult to injury, while reviewing the documents and preparing for my testimony today, I discovered not only did the school receive my GI Bill benefits for my attendance, but they double dipped by receiving and keeping additional federal dollars and the student loans I was forced to take out. I'm here today to ask you to protect all students and veterans from targeting their GI Bill benefits and to stop schools from offering programs that leave students with nothing but a mountain of debt and a worthless degree. Thank you for your time.
Sean, I want to thank you very much for your comment and thank you for your service.
Thank you, Chair.
Hey, Brady, who do we have next?
I'm admitting Julio the owner of Paul Mitchell Cosmetology Schools. And if you wouldn't mind muting your live stream, I think that's probably what the background noise that we're getting is.
No, not your microphone for this meeting. The live stream that you have going in the background needs to be muted. If you're live streaming the mute, yeah, where'd you go? Can I get someone, okay. Can you unmute yourself, please?
There we go. Sorry about that.
Okay, appreciate it. You will have 3 minutes to speak, and that begins when you start speaking, and welcome.
Okay, thank you. Well, good afternoon. My name is Julio Bello, and I'm a graduate from public high school with a learning disability that made everything about learning hard and challenging. I failed at traditional college and ended up pursuing a career in beauty school. The hands-on education was a perfect fit for my style of learning, and the small positive vocational program became a catalyst for my life. Today, I am proud to be a cosmetology alumnus, a highly accomplished world travel hairstylist, and privileged owner of cosmetology schools. To clarify my position, I am for regulations to make sure we use taxpayer-funded programs wisely. So let's make rules that tighten the loopholes, but let's make sure the rules are smart and simple. On gainful employment, if the goal of the department is to make sure the tuition charged by the schools or the debt acquired by the student has a justified outcome in terms of salary, great. Set the parameters in definite terms. Every year, the department should use the national medium published by the Bureau of Labor and cap the tuition amount to a one-year salary potential of the student by the SOC code. Simple and straight, if my certificate of degree pays an annual median of $32,000, then the tuition for the entire program of the study leading to that should not exceed what I make in a year. Tuition then justifies the established outcome. If I go to a college and pay $160,000 in tuition, but have an annual earning potential of only $45,000, should the college charge me $160,000? Absolutely not. In that case, I should not pay more than $45,000, a fair and justified tuition amount. Keep metrics simple. Use standard published and annual learning potentials. Put guardrails to ensure schools don't charge tuitions that students have no capability of paying back. If the mission of the Department of Education is to provide equal access to education, have an educated and productive workforce, then let's not limit the work of the sector does to raise the bar in vocational education. Thank you for your time.
Thank you. Hey, Brady, who do we have next?
Cindy, I'm admitting Dr. Jay Seller, who's here representing themselves.
Good afternoon, Dr. Seller. Welcome to the public comment. You will have 3 minutes to speak, commencing at the onset of your talk.
Okay. Good afternoon, everyone. My name is Dr. Jay Seller, and I want to thank you for allowing me to be here today. I want to take this opportunity to share my point of view on higher education and more specifically my experience attending a for-profit university. After completing 2 years of undergraduate work in Minnesota, I transferred to the University of Colorado to continue my undergraduate education, seeking a bachelor's degree in business administration. I quickly learned that CU would not accept all of my undergraduate transfer credits, even though the coursework was in my intended major. This was a major setback to my graduation timetable and considerable financial burden. I searched for an alternative institution that would recognize my coursework and maintain my graduation timetable. I discovered the University of Phoenix and what they had to offer. I was persistent and I persevered. The University of Phoenix seamlessly transferred my credits, and I was able to begin my program immediately. I graduated with a bachelor's degree in business administration and management, and I graduated with no debt. I attended classes 3 nights a week for 2 years to complete my degree with the University of Phoenix, all while working full-time. I've been very successfully employed for the last 40 years with academic institutions, and more recently as an executive director for a nonprofit in California health sector. I absolutely loved my experience at Phoenix. It only encouraged my passion to get more education, and thus I have my master's and my PhD. The idea that institutions need to prepare students for gainful employment in a recognized occupation needs to be more clearly defined, and it needs to consider all types of students from various backgrounds. I've attended both for-profit and nonprofit schools and believe that Phoenix provides a rigorous degree program, a challenging course load, and is overly dedicated to helping prepare their students for the job field. I appreciate your time today and work that you're doing on these uncertain times, but feel free to reach out to me at any time. I'm happy to share more about my life experiences thanks to the University of Phoenix.
Thank you, Dr. Sellers. Brady, who do we have coming in next?
I'm admitting Luis Vasquez Contes, who is the National Commander of the American GI Forum.
I'm not seeing him.
Let me, you might have logged in twice. Give me 1 second.
Okay. Or maybe. They're both, looks, somebody's coming. Hello, is this Luis Vasquez Contes?
Yes, ma'am.
Well, good afternoon. Welcome to public comment. You will have 3 minutes to speak, and that 3-minute time period starts whenever you begin to speak. So whenever you're ready.
Well, good afternoon
to the leader and staff member of the Department of Education. My name is Luis Vasquez Contet, and I have served and honored in many capacities on American GI4, which today I am the national commander. The American GI4 was founded after World War II in 1948, when many Hispanic service members returned home. They only found that many opportunity they was observed was not there for them. Our motto since beginning have been education is our freedom, and our freedom should be everybody's business. So you can see why this topic is so important to us. This past fall, we testified to the Department of the importance of the veteran community during the process. Today, I will here again to call closing the 1910 loophole properly. It's a good law, and many veteran organizations found very hard to stop this loophole. In coordination with the Congress, the White House, and many others, it was important and a long-term effort. We were very concerned if any effort is undermined on this law. Our members deserve the best education they can get. And we can start with the country, with the veteran on this. Unfortunately, veteran service member and their family were targeted in some school for another 2 years because closing the loophole would not apply right away to them. Because this delay already billing, we oppose to any attempt to undercut the implementation of this law. I want the committee to take that serious. Delayed implementation for 2 years means they are a mechanic bill to the process so school can adjust it they need to. For many, our members, the yard builders of higher education represent an opportunity to improve their life and the life of their family members. Education is a top reason why many people join the military service. They serve the country, they get a chance to go to school, and this is a big accomplishment. I was one of them. Unfortunately, many people would like to take advantage of veterans and the GI Bill. This is not what we want. We hope that you do the right thing for them. I have said before, but I feel it's important that I will say it again.
30 seconds, Luis.
So you hear loud and clear from me, and I remember. The veteran deserve the best education that the GI Bill benefit can get. They should receive a full value of nothing less to earn the right by serving our country. In the American GI Forum, we have studied this issue with great care. We remain committed to the right thing for veterans, and I hope you do so too. Thank you for the time today, and we look forward to support this process however we can. I greatly appreciate it for your time.
Thank you very much for your comments and for your service.
Thank you.
Brady, who do we have next?
Celia, I just admitted Chassie Blummer, who is representing themselves. Looks like we're just waiting for them to turn on their audio.
Mm-hmm.
There you go, she's connected.
Yep, thanks. Good afternoon, Chessie. I hope the afternoon has found you well. Welcome to public comment. You will have 3 minutes to speak, and whenever you're ready, your 3 minutes will begin.
Okay, thank you so much. I will be looking down because I wanted to write what I said, but I'm more concerned. I apologize for my lack of eye contact.
No problem.
Thank you. Hello, my name is Chassie Blummer. I requested to speak today in hopes that sharing my story will provide understanding in what it's like to be an adult student. I grew up on welfare to a single mother with a mental illness. I was constantly put down by my mother and my peers, told I wasn't good enough and would end up like my mother. I grew up seeing the welfare system through the eyes of the child, which means waiting in long lines at the welfare office and on Medi-Cal, which includes doctor's offices that don't take appointments, which meant sitting on a dirty floor with sick people who are all waiting to be seen and taking their turn as well. This all taught me that I needed to get to work as soon as possible. After high school, I started college with a lot of help from the government, and had I known what I know now, I would have stayed. But I didn't know what I had. I was a kid trying to navigate the fact that I needed money as soon as possible. I no longer had welfare, I didn't have family support, and I didn't have a clue where to start. Being a female, I couldn't just put on work boots and go work in the oil fields full time. I often worked 2 jobs at a time just to make enough money to help support myself. I wasn't asking for handouts or welfare. I was working every single day. Fast forward, I finally get a full-time job working for State Farm here in California. There I was told once again that if I wanted to make more money and promote, I needed a degree. It didn't matter that I was doing the job well and fixing errors of those promoted ahead of me. I didn't have a degree, and that's where I was stopped dead in my tracks. I made the choice to give myself opportunities. While working full-time and being a single mother and then a wife, I went to school full-time on top of my work and home responsibilities. University of Phoenix made me feel great and told me that they would help me get a job with a company that would make the loans worth it and easily payable. I was told those loans were affordable and would take into account my personal life basic bills, mortgage, car, food, health insurance, nothing more. My husband has his MBA and earned his BS and MBA from the University of Phoenix, so I felt the school would be the best option for me because I'd have someone at home to help me navigate the online school and allow me to continue working. So I began busting my tail, earning my associates and bachelor's, even taking some classes and tests to accelerate my degree. I took minimal breaks only to have my son and get married. I didn't delay. I worked extremely hard. Overworked and lack of sleep, but I did it. October 31st, 2017, I finished. Sorry?
You have 30 seconds, please continue.
Oh, thank you. What happens next is not what I was told. My loans and my husband's loans were not considered against the other. Our mortgage was not considered against our loans. Our student loans don't care that our spouse has a loan. Our student loans don't care that we have a mortgage and kids. They care about our gross income, which is what most would consider an amount to be proud of. Our success is surface only. The government has shown that the best way is to work the system, which is just to qualify for free and not to try to promote in your work. Don't get married. Qualify for low-income housing. Welfare and Medi-Cal is the only way to go if going to get out of college without an excruciating amount of debt. Otherwise, you'll drown. Your drive of sense of responsibility and accomplishment.
That's 3 minutes. I apologize.
Okay, no worries. I tried. Thank you.
No, you did a great job, Tessie. Thank you very much.
Thank you for your time. I appreciate it.
Okay, Brady, who's next?
I just admitted Ronald Michelle, who is representing themselves.
Hi, can you hear me?
I can hear you. I can't see you, but that's okay if you don't.
Would you like me to, I don't know how to do that. I don't know.
That's fine. That's fine. It's totally up to you, Ronald, if you want to turn your camera on or not. As long as the committee can hear you, that's what's important, okay?
Right.
So welcome to public comment. You will have 3 minutes to address the committee, and that 3 minutes begins whenever you're ready to start speaking.
I'm ready immediately, and I definitely appreciate the moments. My daughter was a Brooks Institute student from 2004 to 2007. We were told that Brooks was alleged to be a very highly regarded photography institute, and that instruction was wonderful. She entered Brooks and graduated after 3 years. Prior to this entry, we met with Brooks financial advisors and loans were offered. But only the smaller loans would be offered to the students. The Parent Plus loans needed to be held by the parents to get the children to get my daughter into the school. There was no way that she could afford to go to the school without the Parent Plus loans. And so we entered into that agreement with Brooks. We were told that Brooks indicated that many jobs would be afforded to these students upon their graduation, and that Brooks had a 90 to 93% placement rate after their graduation. We were not told that at that time that Brooks was owned by a for-profit company, Career Education Corporation. We understood that Brooks was an educational institute with the children's best interest at heart. Interest rates, we felt were very high. I think they were set at 7.5%. We borrowed over 3 years, we borrowed about $72,000, and we were told that a forbearance would allow the student to graduate and get out into the world for a year, and to get a job that would assist in paying back these loans. But there were no jobs. Brooks lied to us where they gave us false information with regards to the actual jobs that were going to be available. We chose to defer and go into the forbearance period. Again, we were not told by Brooks, and we were not told by any of the lending institutions that the interest would accrue and compound, and that $72,000 grew to over $135,000 in just a very short period of time. Again, this took us completely by surprise. I paid over $80,000 back on this loan. I borrowed, I think I was advised that the origination loan was $72,000. I paid over $80,000 back, and I still owe $130,000. I think that I place a lot of the problems at Brooks's feet, but I know that the Department of Education, I think that they let us down also with no due diligence with regards to these for-profit companies, for-profit institutions. I'm 71 years old and I'm retired. My wife and I are retired. I was advised many years later that many of these loans are being repaid by seniors, and that many of these seniors are retired.
That's 3 minutes, I'm sorry.
Is that why it goes quick? Okay.
It sure does. Thank you very much for your comments today.
All right. Thank you.
All right, Brady, who do we have next?
I'm admitting Kristen Anderson, who is representing themselves.
Okay. Good afternoon, Kristen. Give her a minute for audio. Good afternoon, Kristen. Can you hear me?
Yes, I can.
Okay, wonderful. Welcome to the public comment section today. You will have 3 minutes to speak, and that 3 minutes begins whenever you're ready to start talking.
Okay, thanks very much. I hope the information is helpful. My name is Kristen. I'm going to speak to you about my experience in seeking gainful employment. I'm a first-generation college graduate. I graduated in 2008, but the story goes like this. In 1994, I was 26 years old. Our kids were 3 and 4 years old, so I had that. I enrolled in community college, then I set out to find some work. I got a call from a company. The company promised me a paralegal job for 1 year of training. I almost left, but I accepted. I accepted the enrollment, worked full-time, attended full-time school. My husband cared for the kids while he worked from home. I completed the program with perfect attendance. It was a 1 year program, 1994 to 1995. I started to get duplicate bills. They were always in 2 envelopes. Calling the lender didn't help. In the end, the final bill turned out to be $13,700. That's $10,700 for the award year 1994 to 1995 with a $3,000 Pell Grant. I appeared before a federal magistrate in 1996 asking for forgiveness. She requested I go ahead and pay that. It wasn't very much money. After the program, I had no units. The program doesn't award credit hours. My earnings for 1998 was $3,000 for a going rate of $5 per hour, which was a decrease in the income I was making as a temporary hire. In the meantime, unable to pay for childcare, transportation costs, and student loan bills, my husband and I went bankrupt in 2003. I believe I was lied to and tricked, and in the end, I'm not a paralegal. Paralegal requires an AA degree. There's no way to benefit from the program. I paid $18,000. So the department doesn't have a lender record of this before 2011. We're continuing to pay on that. So this is the collection of a debt for award year 1994 to 1995. The loan became 26 years old this year. I became gainfully employed in 2008. I went to the community college in my local community. And immediately the next year, 2009, I made $37,000. So there was definitely a benefit. So the program was a proprietor for a for-profit corporation operating a subsidiary that administered the program that I attended. I do see the information on the NSLDS. The OPEID for the program is listed in the NSLDS. The school I attended is not listed on the DAPIP. When completing the education requirements, federal jobs have education requirements. A degree must be accredited.
30 seconds, Ms. Anderson.
Thank you. That's 30 seconds. So I've paid $18K so far. 126 payments reported since 2011, 137 payments, total count on my credit report for the life of the loan. That's it for me. Thank you.
All right, Cindy, I think you're muted, but I'm now admitting Tristan Bonacci, who's speaking on behalf of University of Phoenix.
Okay. Reading. Good afternoon, Tristan. Can you hear me?
Yes, I can. Hi.
Okay, you have 3 minutes to speak, and that begins whenever you're ready.
Okay, great. So my name's Tristan Bonacci. Thank you for the opportunity to share today. I graduated in 2004 from the University of Phoenix with my master's in teaching and education. And at the time I was based in Colorado. I now teach in New Mexico. The reason I chose University of Phoenix was because at the time I was newly divorced. I needed to support myself and I needed to work and get a career. But I couldn't do that at a normal school because I had to work. So I was able to go to 2 lengthy evening classes per week and then work my way through. So I graduated in 2004. So I've used this education as a teacher now for 19 years. And I apply those skills every day. So as you guys are continuing to debate and implement regulations that affect higher education, I would like you guys to consider students like myself that are non-traditional learners, and that non-traditional higher education represents a lot of students in the United States right now. My question is that why doesn't the Department of Education have a seat at the table for people like me? We're really concerned with, undergraduates who are traditional students going there, but there's so many people who are needing to go back to school and change careers like that. So I'm hoping that you can appoint someone like myself, could represent older working adults who are non-traditional students. I know that without this education, working as a teacher with just the undergraduate degree, there's no way I could support myself. So I had to go back to school. I had to do something to figure this out. So I hope that you could listen to this experience, that we can create equal opportunity and access for all students, regardless of their background or their status as a traditional student or not. Thank you.
Thank you, Tristan. Brady, who do we have next?
All right, our final speaker for today is Mr. David Reyes Batista, who is a veteran representing themselves.
Good morning, sir. Good afternoon.
Would you mind pausing if you're watching the live stream? I think we're getting a bit of an echo.
Okay.
If
You
you
might
could
not be
just,
sorry. I got an echo.
if you could just, David, just mute your live stream.
Okay.
And then you won't get the feedback. No, don't mute yourself here. No, unmute
Wait.
yourself here. Do you have the live stream playing in the background?
No.
Okay,
It's
good.
the computer
Thanks.
that's not on.
All right, we're all set, David. You have 3 minutes, and welcome this afternoon. We appreciate you
Thank you.
coming in.
Thank
You have 3 minutes, and that 3 minutes, David, will start whenever you're ready.
Roger that. Thank you. Good afternoon. My name is David Reyes Bautista, and I am a Marine Corps veteran, and I'm here to tell you my story in hopes that you make sure that others do not experience what happened to me at WildTech. I attended WildTech Auto Mechanic School in Long Beach between 2011 and 2012. I learned about them through a TV show that featured veterans wearing their uniforms and who landed really good auto mechanic jobs. The advertisements depicted state-of-the-art equipment and teachers who were industry experts. But in reality, WildTech did not provided unserviceable tools. Teachers were not interested in teaching and only cared about collecting paychecks. At some point, some were even clearly drunk in classroom. WildTech recruiters promised me that my GI Bill would cover the full cost of my education. This was a big factor in my decision to enroll because there's no way I could come up with the money and fall on any shortfalls. Shortly before I graduated, though, I was pulled in the op and I was told that I had to take out student loans in order to finish my schooling, because I was then told that my GI Bill only covered 70% of the cost and that I had to make a choice and either take these loans or get kicked out of school, which I had made the conscious choice to take the loans. My education counselor, who was aware of my difficulties in my personal life, asked me what my kids would think if I didn't finish school. She said if I would be a failure if I didn't sign the loan documents. Biotech also failed to deliver the career services provided. Recruiters told me the school would help me with the resume, writing, and the job search. The career service staff at Biotech did nothing except tell me to bring my resume to businesses. And I did that. There were several businesses that would laugh me to the door and say that was basically a $30,000 piece of worthless paper. I was unable to find work at that time and had trouble since. Since graduating, I have $3,400 in student loans, and I struggled to make payments for years. It wasn't until a decade after I graduated that I learned about the borrower defense and got my loans discharged. But I shouldn't have hadn't gone through that. I should never have been allowed to go through what I've gone through and have them not do what they promised. My experiences are not unique because many other veterans' lives were ruined by
30 seconds.
Profits for schools like Biotech. I don't have my GI Bill left. Even though my loans were forgiven, my bill, I still can't take the opportunity to better myself. You know, I had kids that love me and they support me, but they see me struggling with this because I shouldn't have gone through what I went through and not be able to at least get my GI Bill back, knowing that they took my life's troubles and used it to their advantage to coax me into taking the loans and doing what I did, and come to find out nothing mattered. It was it's still it's tough right now still, and I've had trouble since.
All right. Thank you, David, for sharing with the committee, and thank you for your service.
Thank you again. Thank you for your time. I really appreciate you guys.
Okay, that concludes all the public commenters today, and we are at a little bit over 4:33. I just want to take a quick opportunity to thank this committee for their very work today. I do appreciate it. We will see you all in the morning.